we are doing the chapter interest rate swaps, where yesterday we discussed swap pricing, how to determine the fixed rate leg for a swap transaction. Please stop talking. Today we will do swap valuation, how to value a swap asset or swap liability, number one. Second issue, we'll discuss about interest rate options, call option and put option in case of interest rates. How to value them, we'll be discussing next, which we call as caps and floors. Then swap options, also we'll discuss few problems. This we'll try to cover in the today's session, probably the first session. Second session, anything left now as a target will complete, and then also start with the chapter currency swaps, which will complete on Tuesday's class. Okay. Now, I asked all of you to be here on time by 6:30, but I could not see persons full attendance at 6:30. So I decided to do one secret problem called as day count convention. Quickly we'll do a problem called as day count convention. Just a way of calculating interest, nothing great. Let us do that sum quickly and then continue with the valuation. Take question number 8. Take question number 8. A small 5 minutes problem. Let's complete it quickly. Nothing great to learn that. Please take question number 8. Shh. Now silence here. Please don't talk. Take question number 8. Principal is $100 million. Interest is 8% per annum. It's a coupon paying bond where interest is payable on March 1 and then September 1. Calculate the interest from March 1 to July 3. Suppose you want to hold it only up to July 3 and then sell it. In the price will include the interest or not? Or a person buys you at July 3, this interest is going to be a come interest for him, right or not? Calculate interest from March 1 to July 3 under the following day count conventions. 30 by 360, a normal corporate coupon bond. Actual days by 360, which is used by money market instruments. Actual days by reference period, this is used by government bonds. Okay, called as what? Treasury bonds. Okay. Different instruments calculate interest differently. There are three conventions: 30 by 360, actual days by 360, actual days by reference period. This is what we have to calculate. Three types of interest calculation is going to be done. Shall I proceed or not? No. Even in one of the previous sum, we said 30 by 360, use it for an interest rate swap. No. These are all the three conventions of calculating the interest. Just to be aware of it, if they ask you, you should know how to calculate. No? That is why it is being discussed. No. What's happening here? Please. Shh. Shall I proceed on? No. First convention is 30 by 360. Interest is payable 2 times a year. Every half year we take as 180 days. How many days here? 180 days. Can I proceed? That means year is having how many days? 360 days. Okay. Now, here 30 means whether it is January or February or March, a month will be taken as how many days? 30 days. Can I proceed what I am saying? So, we don't take the actual days in the month. We don't take the actual days in a year. We simply assume that a year consists of 360 days. 2 exact half years of 180 days, and every month comprises of how many days here? 30 days. Okay. In this case, how to calculate the interest is the issue. Yes or no? 8% per annum. What is for every coupon? 4%. Interest is 8% per annum, that is divided by 2. For every period, how many days is going to be? 4%. That is, every 6 months, interest is going to be how much percent? 4%. I am going to calculate interest for what date to what date? March to July 3. Everybody following up? Now, please tell me, March, how many days? 30. That is 30 by 360, na? March 30, April 30, May 30, June 30. How many days? 120 days. July 3 should be ignored because on that day only interest is going to be paid. Plus July 1 and 2, how many days here? 2 days. I am going to calculate how many days interest? 122 days interest in case of a coupon paying bond. Everybody, are you following? Huh? Solupa, yes or no? No need to copy, first participate. So, first is 30 by 360 days convention. So, the calculation is, what is the principal? $100 million. On which, what is a per period coupon? 4%. This 4% is for how many days? 120 days. Out of how many days here? 180 days. If you calculate, I will be getting 2.71 million as what? Interest. This is called as what convention? 30 by 360 days convention. Yes or no? Next. Second convention, what is this? Actual days by 360. Here, denominator 360. So, every half year take us how many days here? 180. That's not an issue. No. But here, the numerator is what days? Actual days. Actual days, na March, how many days? 31. April, how many days? 30. What is the total here? 61. May, how many days? 31. That gives you what? 92. June, how many days? How many days here? 30. That gives you what? 122. Plus how many days further? 2 days. How many days interest here? 124 days. So the calculation is similar. Can you all tell me what is the actual by 360 interest calculation? $100 million into 4% into what by what? 124 divided by 180. That gives you 2.76 million. I want a clarity. Yes or no? Third is what by what? Actual days divided by reference period. We don't say for both March and September it is 180 days each. It is not so, because March to September is different. September to March is what? Different. The months are having different days or not? My interest is between March to September. This reference date. How many days in March? 31. How many days in April? So March is 31. April is how many days? 30. May is 31. June. July. July is what? 31. August, 31. What is the total here? 184 days. That is, March to September reference period is having how many days here? 184 days. September to March will be having only how many days? 181 days. That's not having the clarity or not. So, denominator also I take the actual reference period. I don't say interest says, and year is 180 days. Two different reference periods got what? Different dates. Okay, now, in this case, ரொம்ப simple. It is second case, 124 numerator. Denominator will be 180 or 184 or 184. In that case, $100 million into 4% into 124 divided by 184. That gives you 2.69 million. So, this is the interest calculation using actual days by reference period. Everybody are having the clarity or not? That is, in bonds and all, one should be clear about how we are going to calculate the interest rates. So, these are all the different day count conventions for calculating the interest rate. Otherwise, there will be fight happening why this amount of interest is not debited or credited. So, any instrument before we issue, you have to also specify the day count conventions for calculating the interest rate. Are you following? Should I explain once again? Can I proceed? Okay, all of you tell me. Yes. First is what? 30 by 360. In which every month will be taken how many days here? 30 days. Half yearly interest now, both half years is going to have how many days? 180 days. Like that we calculate. I don't know. Next. Actual days by 360. Now, half yearly interest now, every half year will be how many days? 180 days. But in the numerator will be what period? Actual What period? Actual reference period. Now what I'm saying, so in that case, actual days, how many days here? 124. In case of actual divided by what? Actual reference period, it should be what by what? It is actual days divided by actual number of say days in the period that gives you the interest. Can you copy this quickly or not? Please copy this fast before you go to the main discussion. This is just a miscellaneous discussion, nothing great concept-wise in this area. Please. Shh. 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 Finished that? Those who not copy, raise your hand. Please copy fast. Shh. Stop talking, please. Shh. Please. Shh. Those who are not copied, raise your hand. Okay. Shall I proceed on? No. Stop talking, please. Yesterday, we predominantly discussed question number 12, that is swap pricing. A small summary I have to do because it will be having some continuity in the question number 11, which I am going to do, called as swap valuation. After this question, the chapter becomes very simple and easy in the remaining parts. Okay. These two problems are only little bit technical. Apart from these two sums, all other sums to follow is also very simple, including the currency swaps problem also. Can I proceed on? No. So this is the last major discussion we are going to make in this interest rate risk management area. Please, I don't want noise. Stop talking. Okay. Now, even if you have some lack of clarity in the yesterday's class, don't worry. Now I'll make a small summary. First, let us go for procedure and then see what has really happened. 5 minutes, I'll just summarize this sum and then go to the next sum. See, yesterday's question number 12, the issue was as follows. There is a 1 year swap. How many year swap here? 1 year swap. Where interest are going to be exchanged once in how many months? 3 months. Anybody listening? Huh? That's a 1 year swap where interests are going to be exchanged once in 3 months. The swap is exchange of LIBOR against a fixed rate. The party TMC is going to receive LIBOR and pay a fixed rate. The issue is, for that LIBOR, what should be the fair fixed rate that should be fixed, so that neither party is going to unduly gain or lose in the swap. So now tell me, yesterday's class, the main theme of the discussion is what? Determining the fixed rate leg in the swap against the LIBOR was the discussion. Yes or no? No. Obviously, the fixed rate should be fixed, keeping in mind the interest rates prevailing in the market on the date of the swap negotiation. Respond, yes or no? No. On the date of swap initiation or negotiation, we saw that there are 4 LIBOR quoted on the market, spot LIBOR. Namely, a 3 months LIBOR is quoted at 7%, a 6 months LIBOR is quoted at 7.25%, a 9 months LIBOR is quoted at how much? 7.45, and then a 1 year LIBOR is quoted at 7.55. This 7.55 and the answer we got as 7.55, both has got nothing to do with each other. There is coincidental. Did you follow what I am saying? So these are the 4 LIBOR quoted in the market. Am I right or not? No. In this case, can I say like this? This is 0 to 3. This is 0 to 6. This is 0 to 9. This is what? 0 to 12. These LIBOR rates are what? Quoted. Since all are 0, these are what LIBOR? Yeah? Spot LIBOR. Now, first step we calculate, all of you tell me, is the calculation, to say just a constant rate. What we calculate first step? Forward LIBOR. We calculated what? Forward LIBOR. Tell me what is forward LIBOR? 0 to 3, 3 to 6, 6 to 9, 9 to 12. So how we calculate it is 0.5 into 7.25 minus, this is nothing but 0.25 years, 0.5 years, 0.75 years and 1 year. That's what I am saying. So this is 0.5 into 7.25 minus 0.25 into 7 divided by 0.25. Like that we calculated 0.75 into 7.45 minus what? 0.5 into 7.25 divided by 0.75 minus 0.25. Are you following the calculation or not? No. So don't get mixed into the discussion, just to concentrate on what? Calculation. Now tell me the last calculation is what? 1 into 7.55 minus 0.75 into 7.45 divided by 1 minus 0.75. Everybody yes or no? No. I think we got the number as 7%, 7.5, 7.85, yeah. 7.85 and then what? 7.85. These rates we call as what rates here? Forward rates. Okay. All these are what MIBOR? 3 months MIBOR. All these are what MIBOR here? 3 months MIBOR. Okay. So today's 3 months MIBOR is 7. It will be reset at what? 7.5. At the end of what? 3rd month. Which will be paid in what? 6th month. It will be reset at what? 7.85 in 6th month. It will be paid in which month? 9th month. It will be reset at 7.85 in what? 9th month. It will be paid in what? 12th month. If you want to buy a floating rate bond, this is what you expect to get as what? LIBOR. In this 7% number alone is what? Certain. All the other numbers are what? Expected. Based on what theory? Expectation theory. What the market expects to be the respective LIBOR is found out using what? The spot LIBOR for different maturities. This is the first discussion. Then we calculate a present value factor for the current yields. Present value factor for what? Current yields, which we already know how it should be calculated. Third, we discuss about what? Fixed rate leg. I determine fixed rate as a fixed interest will be how much rupees? X rupees. If I buy a fixed rate bond, I'll be getting X, and then 35 lakhs. If I buy a floating rate bond, what will be getting? 7%, 7.5%, 7.85%, 7.85%, and then what? 35 lakhs. One thing we know that value of the floating rate bond always on reset dates. Always what? On reset dates. Should be what value? Par value. That will be 100% damn sure. Should be always what value? Par value. It always pays the current yield. What I am saying. So on reset date, this floating rate bond value should be what? 35 35 lakh. For swap to start equally, the fixed rate bond value also should be what? 35 lakh. Swap is exchange of two bonds. Exchange of what? Two bonds. I cannot exchange a slipper for a gold. What I am saying? Exchange only gold for what? Gold. Or slipper for what? Slip. In that case, the fixed rate bond also should be having what value? Same 35 lakh. X coupon we equated to what? 35 lakh. And found out the value of the coupon, 66,034 rupees, if I am right. That's what found out. And when you annualize the coupon, the fixed rate like became how much percentage? Yeah, 7.55%. Please understand this 7.55 and this 7.55 does not have what? Any link at all. Everybody are have the clarity. Okay, now. Once you are done that, then I said that receiving 7.55, 7.55, 7.55, 7.55 and also what? 35 lakhs is as good as receiving what? 7, 7.5, 7.85, 7.85. If you find the swap differences, for example, first reset date, a person is going to pay floating, receiving fixed, will pay how much? 7, receive 7.55. Yes or no? He will be making profit or loss? Loss. Second case like he is going to receive 7.5 and pay what? 7.55. Makes once again what? Loss. The remainder to makes what? The profit. This profit and loss and swap, if we discount at the current yield based on what? Expectation theory, it should be what? 0. That means I can say 7.55% is called as par yield. Is what yield here? Par yield. At that yield, the swap pricing, the swap will be having how much value? 0 value. Swap is neither an asset nor a liability. Now sometimes the swap gives me loss, sometimes the swap gives me what? Gain. If all these rates really happens to be this rate in the future, neither party will be gaining or losing. Is proved. We had 200 rupees as difference. That you leave it, you prove through the interest rate swap calculation. Please tell me, everybody, are you understanding my discussion? So this is what we discussed in what? Last class. And a dealer will be adding some margin to the left hand side and what? Right hand side, and quote the swap rate. So this is discussed in swap pricing. Can I proceed or not? Okay. I will take the discussion forward. See, you negotiated the swap at LIBOR against what? What a fixed rate? 7.55. At the time of swap negotiation, these were the spot LIBORs. The LIBOR is hovering around what? 7%, and the 7.55% is unfair or fair? Fair. If you fix the 7.55%, both parties, those who are going to receive LIBOR or receive fixed, will be what? Equally placed in the swap. Now, see, after the swap is negotiated, the swap is what? Negotiated. Then, say 1 year time is there or not. After 2 months or 3 months, suppose this LIBOR rate suddenly drastically increased to something around 8 to 8.5%. 8 to 8.5%. Everybody, yes or no? That is, what was hovering around 7%, now suddenly is hovering around what? 8%. There may be some reason for the, first say the Fed has hiked the interest rate in US. So wherever say interest rate, everywhere is going to be what getting hiked or something like that. Okay. So now the LIBOR is around how much percent? 8%. Can you go and change the swap terms to 8%? It is already what? Decided. Now, at the time of deciding the swap, the LIBOR was really worth what? 7.55. Now, after the swap has been initiated, when the swap is in progress, when the swap is in what? Progress, after 1 or 2 reset days, let's say 1 or 2 what? Reset day, the LIBOR gradually is now hovering around how much percent? 8%. Now, tell me, in this case, both parties are equally placed. One party advantage. One party what? Advantages. Because when the LIBOR is hovering around 8%, person receiving LIBOR will receive the LIBOR around what? 8%. But he has to pay only how much percent? 7.55% as what? Fixed rate. That means a receiver of LIBOR in the swap agreement will be having swap as an asset. What the asset is going to get me what? Future inflows. The swap becomes what? Asset. But the person who has negotiated for payment of LIBOR and receiving what? Fixed, now has to pay something around what? 8% on every reset date and receive only what? 7.55% as a fixed rate. In that case, you will be having swap as what? Liability. When you negotiate the swap, this is okay. But if the expectation theory holds good, if future LIBOR is 7.5, 7.85, 7.85, no problem here. It is neither an asset Not a liability. But if the future LIBOR changes, future LIBOR what? Changes. It becomes 8.5, 8.85, something like that. Now, then person who is going to receive LIBOR is an advantage surely. Paying, say, LIBOR is going to be advantage, disadvantage. On that case, swap will become an asset for one party, liability for what? Another party. Enna paisa no? Now, I ask you one question. At that time, swap is a liability for you, na? He said, please leave me, I will escape. You ask, will I leave you? I am the swap party, you are the counterparty. For me, swap has become an asset. For swap is becoming what? Liability. Now the question is, suppose for some reason you want to exit the swap. You want to exit the swap. Will I leave you to exit? You know, you are exiting, denying me my rightful benefit or not. So I'll say, okay, you can exit, but pay me some money and then exit. Pay the value of my asset and what? Exit. For that I have to value your asset or not. Or you want to sell the swap to some other, I am having a swap asset or not. I want to assign the swap to this person. I want to assign the swap to what? This person. Will I assign free? I'll charge someone some money or not. How much should I charge for transferring the swap? I should know the value of the asset and liability or not. How to value the swap asset and swap liability be the next subject matter of discussion. Did you follow what I am discussing or not? So this is going to be the question 11 discussion. This is the last technical question. Please believe me, once we cross this area, remaining sums and all, whether you understand this or not, also not important. Those sums are all what? Independent, can be done very easily. But these are the two important areas in the swap valuation. Can I present or not? No. So question number 11 is all about valuing the interest rate swap. At the time of initiating the swap, tell me what the value of the swap? Zero. How it is zero? Like that only fixed rate is fixed. If you fix a proper fixed rate, the swap value is what? Zero. But as the swap progresses, the swap value will not be zero. It may be advantageous to one person. Disadvantageous to what? Another. Understand that on this recent date, swap may be an asset for me. Next recent date may even become what? Live. Now it is hovering around 8%. Suddenly demonetization happens. Inter become 5%. They are around what? 5%. What was seems to be a swap liability may suddenly become what? Swap asset for me also. It all depends on whether the future cash flows are going to be benefit or cost. Depends on the movement of what? The floating rates on the given recent dates that determines swap is an asset or liability for a party. Everybody understood the discussion? Huh? Can you start with the problem? Now take question number 11. Take question number 11. Now up to this, what I have discussed, are you following? I am spending a lot of time in the discussion elaborately. No justification if you don't understand it. Okay, take question number 11. Take question number 11. A financial institution has agreed to pay 6 months LIBOR. Tell me, the name of the LIBOR is what? 6 months. That is LIBOR of a different maturity or not. So this is what LIBOR here? 6 months LIBOR. And receive 8% per annum semi-annual fixed interest rate on the notional principal of $100 million. Tell me the swap is to exchange between what and what? LIBOR and fixed rate. For the LIBOR, at the time of swap signing, what the fixed rate determined here? 8%. This would have been fixed using a par yield. Response, yes or no? No. At the time of swap, say, initiation signing, this 8% was too higher, too lower, correct? Have been correct. On that day, who is having advantage? Fixed rate receiver, floating rate receiver, both are having zero advantage. Swap start with what value? Zero value. No. But now this is not a swap starting date. Some days are what? Past. The swap has a remaining 1.25 years life. How many years more? 1.25 years life. The LIBOR rates for 3 months, 9 months, and 15 months maturities are 10%, 10.5%, and then 11%. The 6 months LIBOR rate on the last payment date was 10.2%. Calculate the value of the swap using bond prices valuation method, forward rate agreement value, FRA valuation method. Both methods will give you and should give you what? The same answer. Okay, now just read the question, understand the facts, then we can just start with the solution. Please go through the question quickly. Shall I start? Okay, listen. Now, no need to copy. Not discussing anything further. Let us simply calculate forward rate. Simply calculate what rate here? Forward rate. I'll explain the details of the sum later. Let us first calculate what? Forward rate. Shall I proceed? Now, today, 3 spot rates are given. One is what? 10%, 10.5, 11%. 10% is how many months? 3 months interest rate. 10.5 is 9 months. That's 3 plus 6. And then what is 7%? How many months here? 15 months. So this is 3 months, 9 months, 15 months. 3 spot rates are given. Now, I'm going to find out what? Forward rates. Just follow. No need to calculate. So just no need to copy. Just participate. So see, first is 3 months. Means how many years? 9 months means what? 0.75 years. 15 months means what? 1.25 years. Am I clarity here? Tell me, what is the spot rates given? 10%, 10.5%, 11%. Simply calculation, no logic. Okay, now 3 months is how much percent? 10%. Now, I want to find the forward rate. What forward rate? 3 by 9. I want to find out what forward rate here? 3 by 9. That is, after 3 months, what will be 6 months LIBOR? 3 by 9 means what? After 3 months, what is the 6 months LIBOR? He is called as what? Forward rate. Now, how to calculate? Help me out. 0.75 into 10.5 minus 0.25 into 10 divided by 0.75 minus 0.25. Everybody, yes or no? No. That's 0.75 minus 0.25 is 0.5. So now tell me 0.75 into 10.5 minus 0.25 into 10 divided by 0.5. Everybody calculate and tell me the number, please. Tell me what the number here. 10.75. What is the number? 10.75%. Everybody yes or no? No. Next is, tell me, I want to find the interest rate. What LIBOR? Tell me what the forward rate to be calculated. What by what? 9 by 50. That means I want to find out the forward rate for a 6 months LIBOR after how many months here? 9 months. So how to calculate? Please tell me. 1.25 into 11 minus 0.75 into 10.5 divided by what minus what? 1.25 minus 0.75. That is going to give me 100%. 11.75%. Tell me what the forward rate? 10, 10.75, 11.75. Hold on, then I'll just give you time to copy. Now, interest rate table here. Normally how we wrote in the previous sum. All of you tell me. Period what? 3 months. 9 months, 15 months. What the spot LIBOR? 10%, 10.5%, 11%. Am I right or not? No. What the forward rate? 10%, 10.75, 11.75. What the FRA period for 10%? Tell me what the period? 0 by 3. What is 10.75? 3 by 9. What is 7.75? 9 by 15. Now all of you tell me, what is the common thing between all these 3 spot rates? All are today's interest rate, quoted what? Spot. Difference is what? Different maturities. Response is not. Now, in this case, what is the common? That is 3 months alone, you leave it here. This is a 3 months LIBOR. 10% is what LIBOR? 3 months LIBOR. That will leave it here. There's 10.75 and 11.75. Both are what? 6 months LIBOR. But 6 months LIBOR today, after 3 months, after 9 months, after 3 months and after 9 months. Ennappa response is not. This 10% alone is what? A 3 months LIBOR. The remaining 2 are what LIBOR here? 6 months LIBOR. Quoted today for a future LIBOR. Response. Is that clarity or not? No. This is a forward rate calculation. I want an answer. Yes or no? No. Okay. Copy up to this. Then I'll just give you, let's go for the next stage of discussion. Please copy up to this. Now, I think I have given you the table, step 1 or not. Step 1 in the table. Copy these rates quickly. Please. Don't talk. Page number notes 254. Classroom notes, page number 254. Finished, huh? Nothing to copy. Just 3 blank spaces given. Those who are copied, raise your hand. So those who are not copied, raise your hand. None out of mind. Okay. Shall I proceed? Good morning. Please. Shh. Please copy the working note. Please copy the working note. Okay. I think I have not given for 3 months. No need to calculate. I give only space for 3 by 9 and then what? 9 by 15. Please copy the calculation in the classroom notes. 10.5 into 0.75 minus 10 into 0.25 divided by 0.5 and so on. Please. Finish copying, huh? Finish copying, huh? Those are not copy, raise your hand. Okay, now listen. See, I am now in time 0, where the first cash flow happens after how many months? 3 months. I am between 2 reset dates. Did you understand what I am saying? Okay, reset days once in 6 months. Once how many months here? 6 months. I am in middle of 2 reset dates. From today onwards, I am going to get the next cash flow after how many months? 3 months. And then after what? After what? 9 months. And finally after what? 50 months. Wrong thing. After what? 50 months. Leave it here, please. Shh. Now, see, I have to find out discount factors or not. No. First, I discount by how many months? 3 months. Next, I have discount by how many months? How many months here? 9 months. Third, I have discount by how many months? Yes or no? No. This 9 months our discount is, first I discount by 6 months. And then by what? 3 months. This I'll first discount by what? 6 months. Another by 6 months. And then by what? 3 months. Ennappa respond? Yes or no? No. For this, the present value factor is how much percent? First is what? 10%. For this, the discount to be used is how much percent? 10 point? And for this, what percent here? 11.75%. So discount at 11.75%. How many months here? 6 months. I'll bring the 15th month to what? 9th month. Discount is by how much percent? 10.75 by 6 months. I'll bring the 9th month to what? 3rd month. Discount is by what? 10% for 3 months. I bring it to what? Month 0. So no, like that, I should calculate my present value factor. This calculation, everybody have the clarity. Sollupa. Now I'm just telling you how to calculate what? PV factor. Shall I proceed? No. That means you should help me out in calculating the present value factor. Step 1 or step 2 work? Step 2. Write down step 2. Present value factors. Okay. Now, have I given you space to write the calculation? Sulupa. Okay. Now, 3 months. First tell me. 3 months, the 3 months LIBOR is how much percent? 10%. I should discount at 10% for how many months here? 3 months. 10% is for 1 year, 5% is for what? 6 months, and 2.5% is for what? 3 months. Tell me the, shout pandremba. Tell me what the number? 1 by 1.025. Write the calculation. 1 by 1.025. Tell me the PV factor, 0.9756. Okay. 9 months should be discounted. How many times? 2 times. 9 months should be brought to first what? 6 months. And then brought how many months here? 3 months. Now Solupa. After 3 months, 6 months LIBOR is how much? Solupa. What is 3 by 9 LIBOR? Tell me what the number, please. 10.75. Solupa. 10.75% divided by what? 2. How many days here? 5.375%. Can you all tell me the calculation. I want a chorus answer. Tell me how to do the calculation. What into what? 1 by 1.05375 brings the ninth month to what? Third month. Into 1 by 1.025 brings the third month to what? Month 0. Enna clarity irukka? No. So the number is 0.9258. Check the calculation. Number is 0.9258. Please tell me, are you all following? Shh. Okay. Tell me, 15th month. Tell me, what is the interest rate I should use to bring 15th month to 9th month? Solupa. 11.75. So tell me 11.75 divided by how much is going to be? 5.875. Now tell me the calculation. What the calculation? 1 divided by 1.05875 into 1 by 1.05375 into 1 by 1.025. That is going to give me how much? 0.8745. That gives me 0.8745. That is going to give me point. Correct, Amba? 4.5, yeah? Okay, 4.5, 0.8745. Don't fight for this. Shh. When I discounted 5.875%, I bring the 15th month through what? 9th month. When I discount by 5.375, I bring the 9th month through what? 9th month to what? Third month. By discounting by what? 2.5%, I bring the third month to what? Month 0. So this is what is a calculation. Up to this, everybody are having the clarity. Can I proceed to the next stage of discussion? No. Till now, we only did some basic working that is going to be there in hand for our discussion to follow. Okay, now. Okay. No need to write, participate. I'll give you time to copy later. Shh. Imagine like this here. This swap was a 3-year swap. Can you imagine like this? For you to understand, this swap, how many swap here? 3-year swap. I entered into a 3-year swap for exchange of, for exchange of what against what? Libor against what person? I just entered into how many years swap? For example, 3 years. Question has not given you 3 years. I just imagine to be how many years here? 3 years. For you to have a continuity in discussion. I just assumed to be how many years here? 3 years. I entered into a 3-year swap for exchanging what? Libor against 8%. Which should be exchanged once in how many months? 6 months. This was the swap arrangement. Yes or no? Now, already 1.75 years over here. Already how many years over? 1.75 years over. First 6 months interest flow has been exchanged. 12-month interest flow has been what? Exchange. Now that is what? 1 year over. Okay, so now next is what? 18 months interest rate has been exchanged. Okay, 1.5 years is what? Over. Now what happens is, now I am between 18th month and what? 24th month. What I am saying now, like those understand, I am now in the middle of a 2 recent date. Everybody, are you having the clarity? Yes, okay, now, past is past, leave it. At that time of swap agreement, Libor against 8%. So, in this case, this 8% is favorable to receiver of 8%, payer of 8%, none. I fix the 8% in such a way that receiving Libor or receiving 8%, both are what? Equally good. At that time, like that only swap would have been what? Negotiated. Innappa, yes or no? Shall I proceed further? Now, let's come to the next. Now time 0. Now is what? Time 0. Okay. This is minus 3 months. 3 months ago. And this is what? 3 months. And this is what? 9 months. And this is what? 15 months. Like that you understand. Okay, now. 3 months ago, understand, 3 months ago, I would have had some swap cash flow or not. It might have been gain or what? Loss. Then I reset what is to be received in the next period on the date or not. So 3 months ago, in the previous reset day, the Libor was given as 10.2%. Question, So read the question now. Now read the question. What the question has said here? Now, the question said the 6 months LIBOR rate on the last payment date of how much percent? 10.2%. ரொம்ப simple, yeah. Now, in this reset date, what is agreed in the previous reset date would have been settled. And what is going to be paid in the next reset date will be determined in this fixing date or not. No. So next reset date, what is to be paid is determined in what? Previous reset date. On the day the LIBOR is 1%, 10.2%. Now we have to understand that in the next reset date, the LIBOR against what? 10.2. The fixed is going to be what? Exchange. This next reset date cash flow is unknown or known or known. Cash flow unknown or known or no. Like that, understand that. Next reset day, I'll be exchanging what LIBOR? 10.2 LIBOR against how much percent? 8% fixed rate. This is going to be the first swap cash flow after today. From today, my immediate cash flow is going to happen after how many months here? 3 months. After 3 months, what is going to be exchanged? LIBOR against 8%. What LIBOR? LIBOR determined on what? Previous reset date. What previous reset date? LIBOR 10.2. 10.2 is going to be exchanged against what? 8%. In the next reset date. Yes or no? In the remaining 2 reset dates, I don't know what is going to be exchanged because it is all that is in 9th month, I am going to exchange what? 8% against LIBOR that is prevailing on the 3rd month. Correct? On the 15th month, I am going to exchange what? 8% against LIBOR prevailing on what? 9th month. Should I repeat? Can I proceed? I'll again say, we exchange LIBOR against what? 8%. Now, we are in middle of what? 2 periods. Last reset date, the LIBOR was reset at 10.2. So no, this 10.2 LIBOR reset will be exchanged again 8% in the next reset date. What is fixed on the previous reset date will be exchanged on what? Next reset date. This determination. Follow what I am saying? No, I am just saying how the swap cash flow is going to happen. In the next reset date is going to come after what? 3 months. I am going to exchange 8% against what LIBOR? 10.2 LIBOR determined on what? Previous reset date. Now on the 9th month is the next reset date or not? Don't say, so why it is in odd numbers, why it is not in 6 months? Now from today it is 9th month. The reset is once in how many months? Yeah, 6 months. On 9th month, I'll exchange 8% against a LIBOR. LIBOR prevailing on 9th month, prevailed on 3rd month, prevailed on 3rd month. 3rd month would have been a LIBOR or not. So against that LIBOR, I'm going to want exchange on the 9th month. This I'll come to know only at the end of what? 3rd month, what the LIBOR happening. Yes or no? No. Now, on 15th month, I'll exchange 8% against LIBOR on 15th month, 9th month, 9th month. LIBOR on 9th month, no, only on what? 9th month. So these 2 LIBORs are not known. Yes or no? But we expect them through the expectation theory. What theory? Market will believe a LIBOR to be something on 9th month and then what? 15th, 9th month and 3rd month. So what is a 3 months LIBOR? Look at your forward and tell me it is 3 by 9. You calculate a 3 by 9 LIBOR. Notebook, what is 3 by 9 LIBOR? 10.75%. What is 9 by 15 LIBOR? 11.75%. That is, this is a 6 months LIBOR. This is what? 6 months LIBOR. Expected to be prevailing after what? 3 months. Will be settled in 9th month. This is a 6 months LIBOR. You expect to prevail after what? 9 months. Basically in what? 15th month. That means on 9th month, the LIBOR that is going to be settled is how much percent? 10.75%. It is fixed in what month? 3rd month. And in 15th month, the LIBOR basically is how much percent? 11.75%. To be fixed in what? 9th month. These 2 LIBORs are actual LIBORs are guessing. I am guessing wild guess based on market expectation. Market. Based on the different LIBORs trading through expectation theory, this is what I guess is going to happen to me swap in the remaining period. Now understand that today I am in middle of what? 2 reset dates. From today onwards, I am going to receive 3 swap cash flows. What 3 swap cash flow? One happening after what? 3 months. Another happening after what? 9 months. Third happening after how many months? Yeah, 15 months. And in these 3 swap cash flows, one swap cash flow is known to me. And for this already decided what? The floating rate in the previous reset date. This swap cash flow is unknown or known or no. The remaining 2 are what? Unknown. Which I guess using what theory? Expectation theory. Now, if you see in today's case, this 8% is fair or unfair? Unfair. 8% is not what? Par. It is not what? Par. Because Everywhere the LIBOR is more than what? 8%. That means a person who is going to receive LIBOR in the swap will be having an advantage. He will be laughing and sitting. Yes or no? He will be laughing and what? Sitting. A person who is going to pay LIBOR, receive what? Fixed, will be crying. You know, he'll always is expecting to make only what? Loss. Should I repeat once again? That is, in today's scenario, when the LIBOR is given as in the question 10 something, 10.5 and then what? 11. Number based on the LIBOR given, these are all the forward rates calculated. In today's situation, person receiving LIBOR will receive more interest than paying what? 8%. Person paying LIBOR will be crying. So a person receiving LIBOR will be having a swap asset. The person paying LIBOR will be having what? Swap liability, because the LIBOR has increased. The LIBOR has what? Increased. From the rate at which agreed in what? Earlier date. When the swap was initiated, LIBOR may be hovering around 8%. That's why I fixed the LIBOR against what? 8%. Now suddenly the LIBOR has become bullish and the LIBOR is what? Increased. So now the person who is receiving LIBOR swap, he is going to be at an advantage. The reason is what? The LIBOR has increased. He will be receiving what? More interest rate. Now, this may not be permanent. After, say, another 2 or 3 months or 4 months, a reverse may happen where the LIBOR may drop to something around 3% or 4% also. The interest rates are keep on fluctuating, and that's what I'm saying. Now, in today's scenario, the person receiving LIBOR is having an asset and paying LIBOR is having what? Liability. How to value the swap asset or swap liability is the subject matter of discussion. Everybody, are you understanding my discussion? So now, this asset or liability can be valued using 2 methods. Namely what? Bond prices valuation method, and then what? Forward rate agreement method. Did you follow what I'm trying to discuss or not? Suppose it is something around same number. Something around what? Same number. Or this may be, say, 10.2 against 8. This may become 6.7 against what? 8. And so on. Then I'll be having asset as well as what? Liability. Maybe it may offset against what? Each other. But now one part is clearly at what? Advantage. Another at what? Disadvantage. The swap has become a headache for a person who is going to pay LIBOR. It has become a heart throb for a person who is going to want to receive LIBOR. So because one has become an asset, another become what? Liability. The valuation is going to be the next stage of discussion. Please tell me, are you all understanding? Yes, okay, that's what I just wanted to communicate here. No need to write anything. Let me just dictate. Observations. See, the swap parties are on reset dates between 2 reset dates. On reset data between 2 reset dates between 2 reset dates. After 3 months from today, the parties will exchange a fixed rate how much percent? 8%. Against what LIBOR? 10.2. Which is already determined on what? Previous reset date. Hence, already it is known that party receives LIBOR will make gain in the immediate approaching settlement date. So the first settlement date, receiving LIBOR is going to make what? Gain. Not only that, we can even observe that. Further, we can observe that forward rate for 6 months LIBOR, 3 months from now is 10.75, and 6 months from LIBOR, 9 months from now is how much? 11.75. As per expectation theory, these 2 LIBORs are expected to be exchanged against the fixed rate of how much percent? 8%. On the remaining reset dates, namely 9th month and what? 15th month. Listening, Hence, as per the market expectation, the person receiving LIBOR is likely to gain in the remaining 2 swap cash flows also, unless something drastically happens to what? LIBOR. That makes the LIBOR what? Fall. Everybody, are you having the clarity? Thus, we can conclude that the swap has become an asset to the person receiving LIBOR and is likely to give him benefits, and is a liability to the person paying LIBOR, as is likely to make him what? Bear losses. Is what you have to understand as a concept called as what? Swap asset or swap liability. Answer me. Are you following what I am discussing? So now we are going to see how this swap asset and liability should be valued, the subject matter of discussion in this segment. Please tell me, yes or no? Okay. Now, if you want to copy this. You want to copy this? Okay, you want to just copy this. Now, inga space irukapa? Somewhere, yeah. Squeeze and water, write it if you want, or write it wherever you want, in the loose sheet or anywhere. I just said if you want, you can just copy this. Let us do it together. Okay. Shh. I will also draw along with you. Why you are shouting? Okay. We are going to exchange Libar against what person? So Libar against 8% is going to be exchanged. Libar against 8% is going to be exchanged. Now. Okay. 3 months ago, was what? Previous recent date. Now, what's the time? 0. Now, what is the first recent day from now onwards? 3 months. Next will happen after how many months? 9 months. Third will happen after how many months here? 15 months. What is determined on previous reset day will be exchanged on what? Next reset day. Now, what was there in previous reset day? 10.2%. Okay, this is the fixing rate. What rate here? Fixed rate. What rate? Fixing rate. This Libar fixed will be exchanged on next settlement date. Yes or no? No. So, look, fixing rate is 1%, 10.2. Now, tell me the first swap cash flow will be what against what? 10.2 against what? 8%. In number, correct? 10 point against what? 8%. So, this is point number 1. Yes or no? No. Next is. Now, what I fix in third month will be exchanged in what? Ninth month. Now, can you all tell me the fixing rate in third month? 3/9. You have to see what rate here? 3/9. What is 3/9? 10.75%. This is what rate? Fixing rate. Tell me if you want what rate? 3/9 rate. Fixing rate is called as 3/9 rate. This is going to be exchanged in what? Ninth month. Tell me what is the number? 10.75. Exchange against what? 8%. Everybody, yes or no? No. Again, I fix another rate. Yes or no? So what rate to be fixed here? 11.75 here. 11.75 is what rate? Fixing rate. Which is what? 9/15. The rate fixed on which month? 9th month. To be exchanged on what? 15th month. On 15th, what exchange? 11.75 against what person? 8%. So, and all this should be multiplied by 6/12. This is all 6 months Libar or not. So, this 8 becomes 4. This 10.2 becomes what? 5.1. This 8 becomes 4. This becomes what? 5 point some number. 5.3 is on 5 and so on. So, this is all annualized rate. It is what Libar? 6 months Libar. Now, always multiply by what? 6/12 for netting of the swap cash flows. Tell me, or I'll have the clarity or not. Now, this diagram is giving you the full clarity. Where you wrote this? In the notebook or modulo, anywhere, you just give a link for the explanation. So I think this will make you much more better compared to the notes which I have dictated that everybody have the clarity. Okay, now let us go for the valuation of the swap. Let's go for what? Valuation of a swap. Now all of you listen. Value of a swap can be found out in 2 ways. Bond prices valuation method. Bond prices valuation method, and the next method is what? Forward rate agreement method. Okay. Now see, swap is nothing but taking a position in 2 bonds. Swap is nothing but what? Taking position in 2 bonds. For example, same problem only. Swap is between 2 parties, A and then what? B. A is going to, suppose, pay Libar, receive what? 8%. Okay. Now tell me, for A, he has taken position in 2 bonds. A has issued what bond? A has issued what? Floating rate bond. Has invested in what? Fixed rate bond. For A, floating rate bond is an asset or liability? Liability. Fixed rate bond is what? Asset. To simply say, A has issued. A has what? Issued. What bond? Floating rate bond. A has what? Invested in what bond? Fixed rate bond. This is what? Liability. This is what? Asset. Romba simple. I value the floating rate bond. That is my liability. I value my fixed rate bond, that becomes what? Asset. The difference between the two bond values is a net asset or what? Net liability for the person. No. Same thing will be opposite for B. B has issued. B has what? Issued what bond? Fixed rate bond. B has what? Invested in what bond? Floating rate bond. This is what? Liability. This is what? Asset. At the time of initiation of swap, this liability asset both are at par value. Another par yield. Call us what yield here? Par yield. When the swap started, these two bonds should be having what value? Same value. So the swap is having zero value. But now we cannot say, because now we all know the floating rate bond should be having more value than what? Fixed rate bond, as the coupons are higher. So in that case, the swap will become a liability for A and what? Asset for B. Is something but difference between the two bond values will be what? The value of the swap. Because what method? Bond prices valuation method. So value two bonds here. Please value what bonds here? Two bonds. The net of the two bond value. One bond is an asset, another bond is what? Liability. Your wealth is, I say, 11th standard now. What is net worth or not? What is wealth here? Wealth is asset minus liability or not? So the swap asset minus the bond asset minus liability bond gives you what? The net asset or what? Net liability. That will make a swap as an asset or liability for you. Is a method number one. Yes or no? Next method I will be discussing later. Can I go and complete the bond prices valuation method or not? Okay. Now see. You are now buying a fixed rate bond. Buying what bond here? Fixed rate bond. All of you, please help me out and tell me what as a bond holder you are going to have. Okay. You are buying what bond? Fixed rate bond. When you buy a fixed rate bond today, you will receive the first coupon on third month. How much coupon? 4% coupon on principal of 100 million. Yes or no? 100 million principal or 10 million? Okay. So after 3 months, I'll receive half yearly interest. Don't they pay 3 months interest? They pay the same coupon once in what? 6 months. So after 3 months, I'll receive what? 4% coupon on how much million here? 100 million. This cash flow number one. Cash flow number two is after how many months here? 9 months. I receive another what? 4%. I receive another how much percent coupon? 4% coupon. Yes or no? After 9 months. After 50 months, I'll receive what? Another 4% coupon and 100 million also. That's what I'm saying. Now, if I discount all these to today, at the present value factor already calculated using the current yield. Using what yield here? Current yield. I'll be getting a fixed rate bond value today. Now, my question is that fixed rate bond value without calculation, tell me, will be 100 million face value, not the face value, not the face value. Will be more than face value, less than face value. More or less, less, because people are expecting something around 10.2, 10.5, 11.75, etc. But you are only paying what? 8%. The coupon expects are what? Different. But what you pay is what? Different. They are willing to pay only what? Discount for your bond, so that along with the capital gain, will be getting what? The required number. Are you following? Sulupa, yes or no? Should I repeat? Can I proceed? This side the class. Okay, now, let me just value the fixed rate bond. Don't copy, first participate. Okay, valuation of what bond? Fixed rate bond. So, when I buy, suppose I'm having it, I'm going to sell you. When I sell you the fixed rate bond, what the value of the bond will pay for me? Present value of future cash flows, discounted at required rate of return, the current LIBORs. Can I got what I'm saying? So, no. That means, what is the future cash you're going to get? You're going to get after what? 3 months, after 9 months, after 15 months. What do you get after 3 months? 4 million coupon. How 4 million coupon? 4% interest on how much? 100 million. After 9 months, what are you going to get? 4 million coupon. After 14, what are you going to get? 104 million. Why? 100 is the value. And 4 is what? The coupon. You'll be getting how much here? 104 million. Everybody are having the clarity. Sulupa. Okay. Now, if the yield is always 8%, LIBOR is 8% flat here. Whether it's 3 months LIBOR, 6 months LIBOR, 9 months, etc. What is the LIBOR here? 8% flat. The bond value should be 100. But the LIBOR is having different LIBORs are there or not. So I found out the present value factor earlier or not. So discount using the PV factor already calculated. You need not copy this factor calculation once again. Are you following? Huh? So just, we already calculated the number, just copy and paste. I'll be getting the discounted cash flow. So this is the value of one bond here, fixed rate bond. So the fixed rate bond is worth how much? 98.55. Tell me why it is worth 98.55? Because the fixed bond pays only 8% group. But in today's world, people are expecting something around 10.5%. So when the current yield is around 10.5%, you're paying only what? 8%. Obviously, a bond should be trading only at what value? Discount only, because they have to at least make it through what? The capital gains. Right or not, what I'm saying. So this is regarding point number 1. Get up point number 1. Shall I proceed or not? What thing? You look in the nice lebriya. Did you understand it? So this is what value? Fixed rate bond value. Response yes or no? No. Next. Floating rate bond value is very easy to value. Floating rate bond always trades at par during reset dates or not? Okay. When it comes to reset date, it becomes 100 million. Yeah. Whatever may be the LIBOR, it becomes how much million? Yeah? 100 million. Once it reaches what? Reset date. My question is, this floating rate bond will be trading at par or will not trade at par? Will not trade. Because I am not at -3 months, nor at what? 3 months. When I come to 3 months, the bond value becomes 100 million. I know in between what? 2 dates. Respond yes or no? Inge listen. I'll say, this floating rate bond will be trading higher than par value. Reason is, last reset date, I agreed to pay 10.2% or not. But today, the person is wanting only how much percent? 10%. Spot LIBOR is how much percentage? How much percentage? 10%. Yeah, so what percentage? 10%. Am I right or not? So I expect that 10, that is, I am expecting now only what? 10%. Now the LIBOR has what? Dropped. I expect only how much percent? 10%. But the previous LIBOR is how much percent? Yeah, 10.2. In that case, this is going to give me some higher money than what I expect or not? No. Apart from that, all the future money will be paid what I expect, because I expect current yield, they also pay what? Current yield. Due to the small change, I'll be having a floating rate bond trading at what? A higher value. Did he expect us? Understand what I'm discussing or not? Okay, now I'll ask you a question here. Floating rate bond valuation, you should understand it a little bit conception only. Now, when you buy a floating rate bond, when you buy what? A floating rate bond. I'll say like this. The period is, you receive cash flow after what? 3 months. After 9 months. After 15 months. Respond yes or no? No. After 3 months, you receive 10.2% or not? That means how much million? 5.1 million. Is correct? Why 10.2 is for 1 year? They pay how many months coupon? 6 months coupon. How much they pay? 5.1. I receive 5.1 after 3 months. Yes or no? And after 9 months, after 50 months, I don't know what I will receive. Correct? I don't know what I will receive. One thing is, I know after I'll be receiving what? $100 million plus 2 coupons. So what I want to receive in 9th month, I know only the 3rd month end. What is in 15 only at what? 9th month end. Sir, if I don't know the coupon, how to value? Don't worry. I'm going to have some cash flows or not. The present value of these cash flows at the end of 3rd month is 100 million. It comes back to par value, because at the end of 3rd month, I know that whatever I want in 3rd month, I'll get in what? 9th month. At the end of month, I know that what I want in 9th month, I get in what? 15th month. Please understand, I'm going to reset the coupon rates on the prevailing date or not. So please understand that some cash flows I'll get at 9th month. Some cash flow get at what? 15th month. The present value of all the cash flows discounted at the current yield on those dates will come to what? 100 million at the end of what? 3rd month. Why it will come to par value means, if I want 18%, it will pay me 18%. If I want 16, pay me how much percent? 16. If I want 12, pay me how much percent? 2%. So in that case, after the next reset date, the present value of the future cash flow discount to the reset date will be always what? A par value. That's what I'm saying. The coupon, the floating rate bond will always trade at what? Par value. That is the value of the floating rate bond at the end of third month is how much? 100 million, because it is going to get what? The desired coupon, plus I'm going to get what? 5.1. Imagine like this. I'm going to hold the bond only for 3 months and sell it. Imagine like that. I'm going to hold the bond only for how many months here? 3 months. And then what? Sell it. What they get? 5.1 million and then what? 100 million. In the paisa, so this is what I'm going to get or not. So these two cash I will discount to what today at what percent? 10% current yield. I'll be getting the value of what? The floating rate bond. I want an answer. Illam puriyadha. Yes, solra. Enakku doubt ave irukku. Are you understanding? Those are understanding this, raise your hand. Should I repeat? Should I repeat? How to teach? Puriyalama. See, so elaborately, I'm teaching you from the base and very deeply I'm just teaching what are the concept. Please understand, I'll challenge you, take any textbook, any lectures, you will not be getting what such a insight into all this here. But you have to put some premium for what is being discussed. So you should be listening carefully. Focus are required. Now, Balba, I'll just explain once again. First of all, my first question is, fixed rate bond value na? What the value of the bond? Present value of future cash flow. When I buy a 15 month fixed rate bond today, I get 4 million in 3 months. 4 in 9 months. 1 or 4 in 1, 50 months. Discount the current yield, that is 0.975, etc. I'll make the bond value. This is why the fixed rate bond is trading at discount. Yeah. Bond is giving 8%. But the current Libor hovers on what? 10 to 11%. Then who will pay par for a bond paying low coupon? They pay only what? Discount. The bond is valued less because of the less coupon. Now, this I have the clarity. Now, that means, can I say I have cornered? I should explain the floating rate bond evaluation once again. Okay. Now, you are buying a floating rate bond. You are buying what? Floating rate bond. Tell me what they're going to get. I'll say period and then what? Cash flow. Now, you're going to get period and then cash flow. Tell me in which month? Third month. You get the first cash flow or not? When you buy the floating rate bond, your first coupon gets in what? Third month. That coupon is known or not known or already known. Remember the previous reset date or not? So what was the reset coupon? 10.2. Which you get in what? Third month. I'm going to get how much percent? 6 months now. How much percent? 5.1%. And 100 million gives you what? 5.1 million will be the coupon I receive in the third month. Next is what month? 9th month. I receive coupon or not? Floating rate coupon, you know what you're going to receive, you don't know. You don't know. Why you don't know? Because 9th month I'll receive coupon fixed on what? Third month. Yes or no? So 9th month receive what? Coupon that is fixed on what? Third month. Respond. Yes or no? No. And on 15th month I receive coupon or not? Yes. This coupon is known or unknown? Unknown. I receive the coupon is fixed on what? Fixed on what? 9th month. I receive the coupon. Is it clarity? And I also receive on 15th month what? $100 million redemption. $100 million what? Redemption. This is a cash flow from the floating rate bond. Are you listening or not? No. Here, please understand that. Apart from this coupon, all the remaining coupons are current yield. If at the end of the third month I want 20% coupon, I'll get it on 9th month. If I end of 9 months, I want 2% coupon, I'll be getting in what? 15th month and so on. Please understand that except for the third month coupon, which has been already what? Fixed. All remaining coupons are current yield or what? Current yield. Now, forget this third month. Now, this is 0. Now, after 3 months, I want to sell a floating rate bond. I want to sell what bond? Floating rate bond. Suppose I want to hold it for 3 months and sell after what? 3 months. At the end of third month, I'll sell this floating rate bond for 105 million, 95 million, 100 million, 100. Because on this day, the bond promises to pay its buyer what rate? current yield as a coupon every time or not. So if they want 8%, it'll pay what? 8. If they want 12, it'll pay what? 12. That means at the end of the third month, the value of the bond is 100 million. Solupa. What the value of the bond? 100 million. This 100 million is nothing but the present value. It is nothing but what? The present value of the future coupons and what? Redemption. Discounted at what? The current yield. Called as what? The respective labor. That gives how much million? 100 million. I want an answer. Yes or no? Yes or no? No. Now tell me, this 100 million is what? Value of the bond at the end of what? Third month. What is the value of the bond at the end of third month? The present value of what? All the future cash flows in what? The 9th month and 15th month. So cash flow not known. You need not know the cash flow because the cash flow is what you want. It will be what? Paid. When they pay your required yield, it will be paying how much value? 100 million value. So whatever may be the labor, the value is what? 100 million on the reset date. Yes or no? Now imagine like this, yeah. Now you are going to buy a floating rate bond, keep it for 3 months. Keep it for what? 3 months. What do you get? 5.1 million and sell it for 100 million or not? You get how much? 105 million at the end of what? Third month. Discounted a current yield, how much percent? 10% for 3 months. I get the value of the floating rate bond today. Yes or no? Either way, I cannot tell you anything more if you don't understand by heart it. Can I say or not? Yes or no? No. I ask a question. Suppose I am not between two reset dates. I am now here. I am now in what? Third month. In the case, should a value floating rate bond? No need to value. It is always at what value? Par value. I am valuing floating rate bond itself because only one coupon is aberration. One coupon is what? Aberration. It deviates from my current yield. All the coupons are what? Current yield. So this coupon alone should be taken. The floating rate bond trades more than par because they are going to pay me what? 10%. But in today as well, I want they are going to pay me 10.2. But I want only how much percent? I discounted current yield of only 5% or 10% per annum for 3 months. Yes or no? In that case, that is why the floating rate gains what? A little bit extra value. I want an answer. Did you follow the valuation of floating rate bond or not? No. All of you, see, I'll just calculate this. So valuation of what bond here? Floating rate bond. When I buy the bond, I get after 3 months, after 3 months. How much? 5.1 and then what? 100. Don't say, sir, what if I keep it for 15 months here? Holding period does not affect the value of the asset. Number. When we discussed equity valuation, we discussed or not? So holding it does not value affect the value because so I am losing another 2 coupons. The remaining 2 coupons and redemption is discounted how much? The current yield to get what? 100 million. This 100 million represents what? The remaining 2 coupons to be received as well as what? The redemption to happen. What I am saying. So in that case, the PE factor has been multiplied and I get the value so much here? 102.53. Everybody, yes or no? No. Let us not get lost here. Let's come back to a discussion. We are valuing what? We are valuing a swap. We are valuing what? A swap. All of it, listen. A has entered into a swap where he pays labor, receives what? 8%. That means, since he is paying labor, he has taken a liability or issued what? Floating rate bond. He has purchased what? Fixed rate bond. Is accepted or not? Floating rate bond is a liability. His liability is what? Something around 102.53. What is his asset here? 97.56. He is going to receive only lesser coupon. Asset is what? 97.5. So what liability here? 102.53. The difference is called as what? Swap liability. Or number, what number here? 102.53 minus 97.56. Tell me, sorry. What is the value of fixed rate bond? 98.55. 102.53 minus what? 98.55 gives the asset of liability liability. What the number, please? 3.98. So the swap liability is how much here? 3.98. The same thing will be opposite for him. For him is going to be how much? 3.98 as what? Swap asset. ரொம்ப simple. If this person says, please relieve me from the swap now, he will allow them to be relieved after paying what? 3.98 as compensation. Or if you want to assign the swap to some other person, he has to pay 3.98 then what? Assign. So that he starts with one a fair swap. No. This person wants to sell the swap, want to sell the swap. Asset can be sold or not. When he sells the asset, he can sell how much rupees here? 3.98 will be the amount to be sold, the given swap agreement. Everybody, yes or no? So 3.98 million is what? The value of this interest rate swap, which is an asset for one person, liability for other person. This can be traded in the market. Yes or no? No. To put it simply, he is something like a writer, he is something like what? A holder. Not exactly, this position may change next time. Suppose the LIBOR drastically decreases, this may become what? Asset. And this may become what? Liability also. It all depends on the interest rate movements. Daily the swap prices may change based on what? The LIBOR is changing on a day-to-day basis. Tell me, are you following how this should be valued or not? Now, we should copy. Should we copy? Okay. Now, up to this, I have typed and given to you. Have you all taken the sheet? Okay. After observation, method 1 is what method? Bond prices valuation method. So first we are valuing the fixed rate bond. Please copy this quickly. So please don't copy the factor calculation again. We already calculated once. I'm working on separately or not. Simply write 0.975699248.88. 8745. Just say copy the factor alone, don't copy the calculation, please. Shh. Finish copying. Finished? No. Those are not yet copied, raise your hand. Okay. Can I proceed? Step 2. Valuation of floating rate bond. Don't ask me a doubt. Sir, bond will give me 2 more coupons and what? Redemption. What happened? Question is just now. The value of the 9th month coupon, 15th month coupon, 15th month redemption, all this discounted to what? 3rd month is only 100. Put it up. All this only is going to be what? 100. So I have considered everything in that 100 itself. Getting 100 at the end of what? 3rd month is as good as getting what? 9th month coupon at the current yield, 15th month coupon at current yield, and 100 million at what? 15 month discount will be getting what? Same 100 only. Are you following? Finished? Finish copying? Shall I proceed? Okay. Let's go for the next step. Step 2 or step 3? Step 3. Step 3 is what? Swap valuation. Can I change the slide? Okay. I'll write along with you. There are 2 persons here. Person 1 and then person 2. Person 1 pays, all of you listening? Yes, person 1 pays what? Fixed. And receives what? Floating. Either swap. Now tell me. Person 1 fixed rate bond is asset, liability, liability. What is a liability value? Tell me the value, please. What's the value? 98.55. 98.55. Person who is receiving the floating rate bond is having floating rate bond as an asset or liability? Asset. What asset? 102.53. 102.53. Tell me, for him, swap is having 0 value. Swap is an asset. Swap is an asset. What is swap asset? 3.98. Other party opposite here. He is going to pay what? Floating. So floating rate bond becomes what? Liability. How much liability? 102.53. He is investing in what? Fixed rate. Hence receives what? Fixed interest. It becomes what? Asset. What asset what? 98.55. So what the swap asset swap liability? What is swap liability? 3.98. The swap liability is 3.98. Swap liability is 3.98. Everybody are understanding it? Solupa. So this is how we should be valuing the swap using what method? Bond prices valuation method. Okay. இதெல்லாம் உட்ருப்பா டிஸ்கஷன்னா forget it. Calculation. அது நம்மளுக்கு இருந்தது. What I'm saying. So forget everything. How many steps are there in bond prices valuation method? 3 steps. Value what bond? Fixed rate bond. Value what bond? Floating rate bond. And then value what? Swap. Swap value is nothing but what? Fixed rate bond minus what? Floating rate bond. This is number 1. Yes or no? Before doing these 2 steps, I should have a preliminary step always. What the step here? Calculate forward rates and calculate present value factor. இப்போ 5 step போட்டோம்பா. First calculate what? Forward rate. I want yes or no. Do you all know how to calculate forward rate or not? You need not know what is forward rate. You are only computer. You don't have knowledge. Okay, so tell me. Computer does not have knowledge. Only have data. Na? So now you tell me, you are a computer. You know only how to calculate. First, you know how to calculate forward rate or not? Yes. Step 1. Step 2, to calculate PV factor, you know it or not? Yes. Step 3, calculate what? Fixed rate bond. Future coupons rate and redemption discount at the present value factor. Step 4 is what? Calculate floating rate bond. Allah first floating rate alone you write it. And don't write remaining. Write what? 100 million face value. Discount be getting what? Value of floating rate bond. Now count the 2 values. They are getting what? Swap value. Now, if the sum comes in examination, they don't conduct interview. Nah. No group discussion. Then they have to only what? Answer. Can you do this sum using this method or not? Sulupa. Okay. Now, we can value swap directly. We can value swap bond. Don't use bond valuation method and all. Let's value swap bond directly. Also, one can value or not. Sulupa. Okay, for that, rumba simple. Now, what I say is, I have discussed this earlier. Forward rate agreement method. Now, see. Now, you are a swap party. Or what a swap party? You are going to pay fixed, receive floating. Now, today is what? Day 0. First cash flow happens after how many months? Yeah, 3 months. Where you pay what? 8%. Get what? That means, tell me the profit here, 10 points. So look, what the profit? 10.2 minus what? How much percent? 2.2 into 6 by 12, na? Divided by what? 2. You get what? 1.1% swap gain for you or not? 1.1 million. I'm going to get how much? 1.1 million as a profit in the first 3 months. So look, next 9th month, you pay how much? 8%. And you expect to receive how much? 10.75 as per expectation theory. What I'm saying? Now, tell me what the gain made by you? 2.75%. Divided by what? 2. Into 6 by 12 or not? So tell me what the number here? 1.375. I get 1.375 million and the notion is what? Swap gain. Put it back. Third case also I make a gain or loss gain. The LIBOR is expected to be how much? 11.75. I pay 8 and get what? 11.75. Tell me what a swap gain? 3.75 divided by what? 2 gives how much? 1.875%. 1.875 million. Why million? Because 100 million no means not now. So as a person is going to receive floating pay what? Fixed. I expect my swap cash flows to be 1.1 million inflow, 1.375 million inflow, and 1.75 what? Million inflow. The present value of this inflow is the value of the asset. What is the value of the asset? Present value of what? Future cash flow. So these are all going to be inflows, outflow, inflow. So person receiving LIBOR is going to get what? The swap inflow. This is value is what? The value of the swap today. If you are going to pay LIBOR and receive what? Fixed. Now all this becomes what? Outflow. Tomorrow outflow. Today it is what? Liability. You're going to be what? Liability. So it is negative, it becomes what? Liability. Positive means what? Asset. You'll be getting the same answer what? 3.8 million under what method? Forward rate agreement method also. Everybody, yes or no? This 1.1 is certain. These two are what? Uncertain. And these are based on what theory? Expectation theory. Probably next time it may even become negative if the LIBOR what drastically decreases after what? 3 months. But today this is what I believe to be what? The value of the asset and then value of this particular asset. I want an answer. Yes or no? Clarity irka? Okay, I'll complete this, then you can just copy. Next is, this is already written now. Can I say 3.98? Notes. At the time of swap initiation, both the bonds will have what value? Par value. Floating rate bond will have par value because initiation rate is what? Recent date. And the floating rate bonds always trade at par on recent date. Fixed bond trade at par value because the fixed is determined based on what? The par yield only. So when the swap was started, floating rate bond trades at par because the recent date. Fixed rate bond trades at what? Par because the yield is fixed based on what yield? Par yield. We discussed in question number 12. Yes or no? No. Next is, as the now the bonds will not be trading at what value? Par value, because interest rates have drastically changed. Based on the current LIBOR codes, the bond values are as follows. Listening up now. Let's say fixed rate bond. Fixed rate bond, it pays a coupon of how much percent? 8%. Is well below the current market yield of 10%, 10.75 as well as what? 11%. Hence the fixed rate bond is trading at what? A discount. Floating rate bond, we are valuing the floating rate bond in between what? Recent dates. Now at the time of valuation, the expected yield is only how much percent? 10%. But in the previous recent day, the bond has agreed to pay a coupon of how much percent? 10.2. Hence the floating rate bond is trading at how much? Premium. Next is. We have already discussed that swap is nothing but exchange of two bonds. Hence, person 1 ends up with a swap asset and person 2 ends up with what? A swap liability. All this has been already explained. If person 2 wants to exit from the swap, he can do so by paying what? A compensation of 3.98 to person 1. So, if the person 1 can sell the swap and asset to any other party for a price how much? 3.98. It should be noted that if tomorrow the LIBOR drastically falls below 8%, the entire position may want a reverse. Purinjada? Okay, next is FRA method. I discussed already now FRA method. Now all of you tell me quickly. 3 months, 9 months, 15 months. What is the fixed coupon? 4 million, 4 million, 4 million. Floating rate coupon is 5.1 million. 10.2 by 2. Next is 5.375. Correct? And third is 5.875. Number. The net amount is 1.1, 1.375, 1.875. Already see, we have written these numbers or not? No. So if we are discounting what? Present value factors, I'll begin a swap value is 3.98. With this swap, valuation has been completed. I want an answer. Everybody, yes or no? Have I given space? Please copy in the space the valuation under what method? FRA method. Please write the numbers quickly. Finish copying, huh? Shh. Those who are not copy, raise your hand. All have finished copying, huh? Okay. Okay. Escaped. Whether understood or not, I want escaped. With this, we have completed what? Swap valuation and swap pricing. From break from now onwards, now one day late. Okay, then you're asking for what? Break. Okay, now. So, stop talking. See. listen here. We have been discussing that chapter called as interest rate swap. Flow away damba. First we learn how a swap transaction take place between two parties. Kadaba. How fixed rate is against what? Floating rate. What is agreed on the previous reset date is agreed in what? Is paid in the next date. This is what has been learned in the first case. Yes or no? Shh. Then we discuss in the second previous class uses of interest rate swap. I can use my swap to change a floating rate asset into fixed rate or a fixed rate asset into what? Floating rate. We have drawn number of flow diagrams to understand that number. So a swap can be used to transform asset or liability of one case to what? Another category. Also has been discussed. I gave 1 or 2 examples who may be using what? Swap in this regard. Third, two parties based on the difference in risk premium in floating bond market and what? Fixed rate bond market can say optimize the interest cost by entering into one swap transaction. Swap arbitrage or comparative advantage I have been discussing the next area in the interest rate swap. You pay for me, I pay for you, and then one knock it off. We discuss or not? No. This is point number 3. Yesterday we discussed how to fix a fixed rate leg for what? A LIBOR when a swap starts. Today we saw that when the swap is in progress, when the interest rate has drastically changed compared to how we determine the fixed rate leg, then the person receiving fixed may be either gaining or losing. How to value swap has been what? Discussed. These are all the issues discussing interest rate swap till now. Everybody following or not? No. Say, 1 minute. Don't think that this may be asked in exam or may not be asked in examination. There are exams which are chapter dominated. Okay. Now, here I just want to tell, except for few sums, most of the sums are institute problems only. It may either come in RTP or maybe coming in what are the examination. Only thing is, institute lab, they don't teach you concepts. Ingendo some copy and want a pasted and the question is being what? Asked. But we are with the background, we are discussing what? All the sums. Okay, now, just only to drive home the value, not for, say, self-promotion, I'm saying, say, then only you'll be knowing the value of the notes given. See, I gave you classroom notes na. I gave you classroom notes, I gave you workbook with lot of solved practice problem. Plus you have the notebook na. This is better than most of the textbook available today. Without cost. Clap, I'm saying. And compared to our notes, you can see any textbook or even any lecture clipping if you have. Okay, so from US to water everywhere. It will not be explained in such detail. Not explain what such detail. How floating rate comes to par value. For that explain 10 minutes. So everything from the scratch till what end has been what explained. This elaborate notes and this explanation will not be there in what books. If you are unable to understand here, you will not be able to understand what anywhere. And even if you are having lack of clarity, go home, sit and read the notes here. Notes is given in the speaking manner only. You will be able to understand everything regarding swap, but never leave it. I am not only saying for swap. This is true for portfolio. This is true for what? Equity valuation or any other issue. Okay. Always book starts at particular level. Yeah. They start at one particular level, assuming that they assume that you know that floating rate bond trades at par. They assume that you know what forward rates. I have taught you forward rates already during what? Bond valuation. I once again discussed forward during swap valuation. There it is different. Here I saw 3 by 6, 9 by 6, everything is what? Explained. Again told you what it represents, so on. So please, if at all there is a value for the lecture, you should be understanding and what reading it. If you leave it, then the entire lecture becomes what wasted. Yesterday evening it started here. Now today what 8:15. Till this time we discuss only 2 sums. One is what? Swap pricing, another is what? Swap valuation. Elaborately, everybody following or not? Okay. Now we are going to start afresh. Forget everything. Jolly. First we come what? Jolly. Good morning, friends. 2 happy news. Only 1 hour 15 minutes left. Correct. 1 hour 20 minutes. 1 hour 15 or 20 minutes is only what left. The first news. Second news is jolly I have to listen because from now onwards nothing great is going to happen. All are simple and straightforward discussions. We have crossed on the point we have crossed what the eye of the storm. Can I say it? Now. Now it is only what a cooling period. The remaining are what a simple and easy discussions, but important. Once again, concentration is required. Now only we are starting. Good morning, friends. Okay. Anything you remember? Forget everything. Fresh. Let's want to start now. Okay. Now, I am now going to discuss about caps and floors. What that is? Caps and floors. Cap na call option. Floor means what? Put option. Interest rate caps and interest rate floors will be the subject matter of discussion. That is going to be the leftover topic to be what discussed. With that, the chapter gets what? Completed. All the interest rates will be getting what? Completed. Everybody, I will have the clarity up now. Please. Let me start with the help of an example. What I am going to discuss now, no need to write a single word. Why? Has been what? Typed and given. That is, in our classroom notes, you have segment 8 or 9. That's correct. Segment number 8. Interest rate caps and flows has been given or not? Now, the notes only I am going to discuss now. Very simple and easy discussion. No need to look at notes. What is that? Is that in what? Slide also. Can you all start with our discussion now? Okay. Forward rate agreement versus caps and flows. We come back to FRA. Forward agreement number kaba. Forget also, no problem. Will be reminded once again. Don't touch. See. All of you. Fresh, listen to this example. With this, the entire discussion will be over. Can I proceed? No. See. A Limited wants to borrow after how many months? 2 months. For 3 months. It is afraid of increase in interest rate. A borrower always fears what? Rising interest rate. Hence it purchases what? 2 by 5 FRA, MIBAR, at how much percent? 5%. In other words, it has agreed to receive MIBAR prevailing after 2 months in exchange for a fixed rate of 5%. Now, again I say, details. We want to borrow today after 2 months. I want to borrow after 2 months. For how many months? So, it ends on which month here? 5th month. So, my transaction is 2 by 5 transaction or not? After 2 months when I want to borrow, I am afraid whether MIBAR will increase or not. So, to protect against that, I go for a FRA. FRA, I can either buy MIBAR or sell MIBAR. I buy MIBAR or what? Sell MIBAR. So, a borrower, discussion, a borrower buys MIBAR, sell MIBAR, buy MIBAR. When I go to borrow, I want to what? Buy MIBAR. If you don't understand, be knowing it, when I just do the sum once again. Okay. So what I did is, I went to the FRA, I went to the bank and entered into what? An FRA. And FRA, say what is FRA? 2 by 5 FRA. What FRA? 2 by 5 FRA. On what? On a 3 months MIBAR. You know, there can be so many MIBAR or not. There may be an overnight MIBAR, a 3 days MIBAR, a 14 days MIBAR, a 30 days MIBAR, a 90 days MIBAR, and so on. That's what I'm saying. So I enter into an FRA. I just want to purchase, sold, purchase. I buy what? I buy fish, I buy tomato, I buy gold, I buy shares, I buy MIBAR. I buy MIBAR. What MIBAR I buy? I buy overnight MIBAR, 3 days, 3 months, 3 months. I have purchased what MIBAR? 3 months MIBAR. The meaning is, I have purchased a 3 months MIBAR at a fixed rate, how much percent? 5%. And I'm going to return after how many months here? 2 months. Rumba simple. What I mean is, after 2 months, that means a MIBAR or not? That MIBAR which is prevailing after what? 2 months will be received by paying what? 5%. Is it number? Yes or no? Should I repeat? Now, tell me the transaction. This is an FRA. What FRA? 2 by 5 FRA. On what? 3 months MIBAR. I go for buy, sell, buy. And what is the fixed rate? 5%. Can you tell me what is the transaction here? I have agreed to. I have what? Agreed to. Buy. I have agreed to what? Buy. What? 3 months MIBAR. I agreed to buy what? 3 months MIBAR. When? After 2 months. At what percent? 5%. Again I say I have agreed to buy what? 3 months MIBAR. After 2 months. At what percent? 5%. That's what I'm saying. Now, after 2 months, the MIBAR is 6%. How much percentage? 6%. I agreed to buy a MIBAR worth what? 6%. For how much percent? 5%. I make a gain or loss? Gain. 1% gain will be booked up. Suppose on the day MIBAR becomes what? 4%. I agree to buy a 4% MIBAR at what percent? 5%. Gain or loss? Loss. 1%? 1%. When MIBAR increases, I gain. This gain will be able to offset my increased interest rate. When the MIBAR what? Decreases, I make what? Loss. The loss will lower interest rate guarantees me what? 5%. It's a forwarded agreement transaction. I want an answer. Yes or no? Should I explain once again? Can I proceed? Okay. All of you participate. In other words, it has agreed to receive what? MIBAR, prevailing after 2 months. In exchange for what rate here? Fixed rate of 5%. Now, look at the details. After 2 months. After what? 2 months. Let us see the situation. Situation 1, MIBAR becomes how much percent? 6%. 6 months MIBAR is how much percentage here? 6%. Or MIBAR drops to what? 4%. These are two numbers here. Okay. Now, when MIBAR is 6%, I am buying MIBAR or not? I receive what? 6%. By paying what fixed rate? 5%. How much I gain? Okay, in the forward rate, I gain 1% or not? Okay, after 2 months, I want loan or not? I go to the bank and borrow money at current yield or not? So I borrow money at how much percent? 6%. So please borrow how much percent? 6%. I borrowed at 6%. In the swap market, I get how much percent? 1%. Tell me what is the effective interest rate? 5%. Ennappa is or no? No. At the end of second month, end, suppose the MIBAR becomes how much percent? 4%. Now tell me, I receive a MIBAR worth how much percent? 4%. By paying how much fixed rate? 5%. Make a gain or loss? Loss. How much loss here? 1%. Now, I went to borrow after second month or not? When I go to borrow after second month, at that day, the interest rate is how much percent? 4%. I borrowed 1%? 4%. I borrowed 4% in the cash market. I pay how much? 1% for the swap market. What is the effective interest on me? 5%. In other case, whatever may be the MIBAR rate at the end of what? Second month, I always have an effective rate. How much percentage here? 5%. When MIBAR increases, when the MIBAR what? Increases, the FRA gives me gain and makes me what? Pay only 5%. But when the MIBAR decreases, the FRA does not allow me to pay what? Decrease interest rate. It books a loss and make me only what? 5%. So whatever may be the MIBAR, after what? 2 months, I have locked myself to how much interest rate here? 5%. This you are understanding what I am discussing or not? Yes or no? Okay. In this case, advantage is certainty. Why certainty? Whatever may happen tomorrow to the interest rate, today I have locked my loan for 5% or not. Any guarantee? No. But a person says, sir, I want to pay maximum 5%. If it becomes 4, I don't want to pay 5. I want to pay only what? 4%. He says, I want to borrow money in such a way that I pay not more than what? 5%. But when the MIBAR drops, I should be able to pay a lesser interest rate also. Like that is any strategy question arise or not? What you can do, instead of forward, go for what? Option. Instead of buying MIBAR, go for a call option on MIBAR. Go for call option on what? MIBAR. So what is the strike price? 5%. Yes or no? No. Go for a call option on what? MIBAR. With a strike price, how much percentage? 5%. Are you all following what I am discussing or not? So in that case, what is going to happen is very simple. We have seen that whatever may happen to the interest rate after how many months? 2 months. The company has logged itself to how much interest rate? 5%. Suppose A Limited wants to pay not more than what? 5%. Then instead of FRA, forward, currency option like that, instead of going for what? FRA, he can buy what? Call option on MIBOR, interest, it is called as what? Interest rate cap. I don't pay more than the cap. Call option on what? MIBOR. At a strike price, how much price? 5%. Romba simple. Take the two situations. After how many months? 2 months. MIBOR becomes 6%. How much percentage? 6%. FSP 6%. Strike price is what? 5%. Is FSP more than strike price? Yes. I have a right to get a MIBOR what? 6%. By paying what? 5%. Will I exercise the right or not? Yes. Solupa. I have a right to buy a MIBOR. I have a right to buy a what? MIBOR. At what percent? 5%. But the MIBOR is worth how much percent? 6%. Will I buy a MIBOR what? 6% or 5%? Yes. So what I do? Exercise a right and then buy what? MIBOR. I receive how much MIBOR? 6%. Pay how much fixed? 5%. How much the book has profit? 1. I go to the bank and borrow how much percent? 6%. So what is the effective interest rate? 5%. That means what I'm saying. So when the interest rate increases, when the interest rate what? Increases, I can still borrow at what? 5% because I can exercise on call and make a profit on the call market. Ennappa respond? Yes or no? Should I proceed? Suppose the MIBOR becomes how much percentage? 4%. Romba solupa. I have a right to buy MIBOR worth how much? 4%. How much percent? 5%. I have a right to buy a MIBOR worth 4%. How much percent? 5%. Tell me as a holder, will I exercise a right or lapse? I will lapse. I lapse. Option to what? Lapse. Only thing I do is what? Borrowed how much percent? 4%. Interest how much percent? 4%. Romba simple. When the MIBOR increases, when the price what? Increases to 8%, 10%, 12%, don't worry. I'll exercise the call option and buy the MIBOR at how much percent? 5%. And the gain in the option will offset what? The extra interest I pay and lock myself to a maximum interest how much percent? 5%. When the MIBOR drops below 5%, allow the option to what? Lapse. And only borrowed how much percent? 4% or 3%. So in that case, I pay not more than what? 5%. But I'm able to pay what? Less than that. Tell me which is better? Option better or forward better? But for this, the writer will charge you some premium. Now for writer, never will get a gain. For him, when the MIBOR becomes 4%, he will not get anything. He will only zero value. But when the MIBOR becomes what? 6%, you make a 1% gain. He has to pay what? 1%. Writer only takes an obligation, will not have what? Any right. So writer charges a premium or not. So for this call option, one should be paying what? Premium. That premium can be calculated using Black-Scholes model. That will be doing in the next part. Everybody having the clarity in discussion. Rumba simple. How we have TCS shares, how we have dollar, we have MIBOR here. Just anga rupees, going to be what? A percentage, that's all. Everything has a price. Tell me, in stock option, what the underlying asset? Stock. It may be TCS shares. It may Reliance buy market. It may be what? TCS shares. It may be what? Infosys shares. It may be what? Anything. Yes or no? In a dollar, in a currency option, what underlying asset? Pound, dollars, etc. In this, what underlying asset? It can be MIBOR call. It can be LIBOR call. It can be T-bill call option and so on. So the reference rate becomes what? Underlying asset. And the strike price becomes a fixed rate. Like respond, have the clarity or not. So we exercise and last based on what? FSP more than X, less than X. Same concept applies for what? The interest rate options also. Are you following or not? Okay. Now, up to this, what I have discussed, those understood, raise your hand. Okay. Now, leave it. Come to next discussion. Thus, A Limited maximum pays how much percent? 5%. Effective interest on its borrowing. It can even be lower if the interest rate in the market falls. This call option, not this, thus call option ensures cap on interest payment and is called as what? Interest rate cap. Why you say interest rate cap? It ensures that I don't pay more than what? 5%. It puts a cap on interest rates or not. So it's called as what? Interest rate cap. I don't pay more than 5%. Dinakaran cap. So interest rate cap is on maximum 5%. Everybody, I have the clarity or not. So next is interest rate flow. Don't. Similarly, ரொம்ப simple. Suppose I want to deposit. I don't want to borrow. I want to want a deposit. So, I want to deposit today after 2 months. I want to deposit after what? 2 months. For how many months here? 3 months. Now tell me, I'm afraid. Should I am afraid or not? Yes. Mind la clarity irka. Slowly listening. Okay, let me reduce the speed. Now tell me. Borrowing over. Yeah, borrowed go for call option, put option, call option, call on me bar. Accept or not? No. I'm now going to become a depositor. I want to deposit today after 2 months. For how many months? 3 months. So I'm afraid or not? What the fear for me? When I go to deposit, if the interest rate falls, what is going to be my fate? A question arises now. So now one option is I go for what? FRA. What FRA? 2 by 5 FRA. What FRA? 2 by 5 FRA. Okay. And I'm going to go FRA for what me bought? 3 months me bar. With what rate? 5%. I buy me bar, sell me bar. Buy me bar, sell me bar, sell me bar. Rumba simple. What I have done is, I have agreed to sell. I have agreed to what? Sell. What? 3 months me bar. After how many months? 2 months. At what rate? 5%. Enappa esa no? You tell me the issue. After 3 months. After what? 3 months. The MIBAR becomes 6%. How much percentage here? 6%. That means I agree to sell MIBAR. That is sell MIBAR what? 6%. For how much percent? 5%. I give MIBAR worth what? 6%. And get only what? 5%. So look, I pay how much percent? 6%. I receive how much percent? 5%. The discussion, tell me, I'm going to make a gain or loss? Loss. What the loss here? 1% loss. I deposit in the real market at what MIBAR? 6%. What the effective deposit rate? 5%. Suppose on the date as I feared, the MIBAR becomes 4%. MIBAR becomes what? 4%. I have agreed to sell the MIBAR worth what? 4%. For how much percent? 5%. That means I'm going to pay MIBAR worth how much? 4%. Receive what? 5%. So pay how much percent? 4. Receive how much percent? 5. 1% gain or loss? Gain. I deposit how much percent? 4%. How much the effective interest rate here? 5%. Whatever happens to me, but I'm able to deposit how much? 5% agreed forward rate or not. So this is regarding the forward rate agreement. Respond, yes or no? Same deposit says, sir, I want to earn minimum 5%. I want to earn minimum what? 5%. If the MIBAR is 8 or 10%, I want to earn 8 and 10% also. I want to earn minimum what? 5%. It should not go below 5%. My interest earned should be what? Minimum 5%. But if the MIBAR turns out to be 8%, I should also earn 8%. 10, I should also earn what? 10%. So in that case, we lock myself to FRA, go for option or option. Tell me what option? Call option or put option? Call option, put option or put option. Respond, yes or no? No. Now I am going to enter into a interest rate put. Interest rate what? Put. With a strike price, how much percent? 5%. That means the meaning is MIBAR put with a strike price of 5%. Tell me what is MIBAR put with a strike price of 5%? I agree to sell MIBAR. I agree to what? Sell MIBAR. For what percent? 5%. 2 months option, I agree to sell MIBAR after 2 months. At what percent? 5%. 8 months option means what? I agree to sell MIBAR after what? 8 months. At what percent? 5%. Is the meaning enappa? Yes or no? No. So in this case, all of you answer my question. Situation 1, MIBAR becomes 4. How much percentage here? 4%. Now tell me, you have a right to, listening, you have a right to sell at what? 5%. Yeah, MIBAR worth only what? 4%. Will you exercise? Labs? Exercise. So I will exercise on labs? Exercise. So in that case, receive how much percent? 5%. And deliver MIBAR worth how much percent? 4%. What the gain from the option? 1%. I go and make deposit in a cash market. How much percent? 4%. Tell me what the effective interest rate here? 5%. Even though the interest rate has dropped to 4%, I'm still earning what? 5%. Now, tell me, if the MIBAR is 6%, how much percent is that? 6%. Tell me a transaction. I have a right to sell a MIBAR worth how much? 6%. For how much percent? 5%. Will I sell something worth 6% for 5%? No. What I will do? Lapse. When I suddenly see you, I become afraid. And I close eyes. Okay, so did you all follow? Now, tell me, exercise and lapse. Okay, tell me what I will do. Go to the bank and invest how much percent? 6%. Then MIBAR becomes 6%. You earn how much percent? 6. MIBAR becomes 4 means I earn what? 5. A floor is insured or not? I minimum earn how much percent? 5%. It is called as interest rate floor. Cap na call option. Floor means what? Put option. If I want to earn between two, I call as caller. I call as what? A caller. Having a call option and then what? A put option. Please tell me up to this. Are you able to understand it? Yes, okay. Now, 1 minute. MIBAR call, just you tell me the transaction alone, no more discussion, just to understand. Now, MIBAR call with a strike price of, suppose, 5%. MIBAR call strike price how much percent? 5%. Tell me what the meaning. I have MIBAR call with a strike price of 5%. Meaning, please. I have a right to buy. I have what? Right to buy. What? MIBAR. Right to buy what? MIBAR. At what percent? 5%. If the MIBAR is trading at 6%, will I exercise? Yes. I have a right to buy a MIBAR worth what? 6%. How much percent? 5%. 1% gain. Yes, no? MIBAR trading at 4%, what will do? Lapse. I have a right to buy at 6%, and MIBAR worth only what? 4%. I will lapse it. Is it correct? Put option on MIBAR, strike price 5%. Tell me the answer. So, put option on MIBAR with a strike price of 5%. Meaning of that, I have a right to sell. Right to sell what? MIBAR. At what strike price? 5%. MIBAR becomes 7%. Will I exchange or lapse? Lapse. I have a right to sell a MIBAR what? 7% only for what? 5%. Allow it to lapse. And if it is going to be 4 means what? Exercise. Did you understand the call option and put option? Now, the summary is very simple. See. All this have been typed and given to you. Okay. Rights and obligation. Rights and what? Obligation. Holder of a MIBAR cap. First one is a holder of what? MIBAR cap. Cap now what? You are a call holder. Right or obligation? Right obligation. What is the call option? Right to buy. You have a right to buy what? MIBAR. Holds a right to buy. Buy means what? Receive. MIBAR and pay how much percent? 5% strike price. A holder of a cap has got a right to buy or what? Receive MIBAR for what percent? 5% fixed rate. Response is no. Right of a MIBAR cap. Now, if you are a writer having a right to obligation, holder of a call is having a right to buy. A writer of a call is having what? Obligation to sell. Yes or no, what I am saying? So, now can you tell me the expansion? What the meaning of here? It's going to be what? Obligation to sell MIBAR. Sell means what? Pay MIBAR. And receive how much percent? 5%. Is the writer of the cap. No. Holder of a MIBAR floor. Holder of a MIBAR what? Floor. Put option holder has got a right to buy, a right to sell, right to sell. Tell me what the transaction? Right to sell. Right to sell means what? Pay. Pay what? MIBAR. And receive what? 5%. And then last person is what? Right of a MIBAR floor. So who is a right of a put option having obligation to buy? Obligation to buy what? MIBAR. That is receive MIBAR by paying how much percent? 5%. So this is regarding the writer, holder and writer, rights and what? Obligation has been what? Discussed. Either who charges premium? Writer. Because writer will never make any profit from what? The option, because he is going to only pay, never going to what? Receive. It is going to be received by him, means other party what? Lapses. So is going to charge what? Premium. How much should be charged? We will discuss in the next sum. I want an answer up to this. Are you having the clarity? Yeah? Okay. Those who understood this, yes or no? Okay. No, okay. Those understood, raise your hand. Okay. Now. Okay. Now. Shall I start with the problem now? Okay. Now. Don't think that I have not given you time to write anything. Whatever I discussed, ditto, has been typed and given in what? The segment A, namely what? Interest rate caps and then interest rate flows. Solupa, yes sir? Interest rate risk management chapter is there or not? In that, take question number 4. They want to write the answer in the notebook from now onwards. No need to go for the classroom notes. Okay, now take question number 4 in interest rate risk management. Shh. Please. Stop talking. Interest rate cap is called as call option. Interest rate floor is called as what option? Put option. These are all nothing but interest rate options. Called as what? Interest rate options. Another name for it is interest rate guarantees. Interest rate what? Option always guaranteed a minimum price or maximum price. In all called as IRGR, interest rate guarantees. Now, noise get near. Okay, shall I start? See, question number 4, page number 240, chapter name is Interest Rate Risk Management. Please. Abhaya Limited. Abhaya means what? No fear. Why no fear? Option is that the protect us. Can I put on that? So another name is given. Abhaya Limited wishes to borrow rupees 10 lakhs. 1 million means what? 10 lakhs. For a year in 12 months time, please. The current rate of interest on such loans is 5%. The risk-free rate is 3%. Interest rate volatility in the recent past has been represented by a standard deviation of 10%. Daily the reference rate moves up and down or not. How share prices can have a standard deviation, currency rates can have a standard deviation, interest rate too has what? Standard deviation. What would be the expected cost of interest rate guarantee on a loan at a 4% interest is the question which has been asked. Okay. Now, no need to write anything. Let me have a discussion where some mistakes we may have in our understanding part also. Let me first have a discussion fully, little bit with intent listen. Once I complete that, we can just go through the Black-Scholes calculation easily. Black-Scholes calculation, 5 numbers I want. Tell me what are the 5 numbers in Black-Scholes I want? Spot rate, spot price, spot price, strike price, term of the option, risk-free rate, standard deviation. These are the 5 factors affecting what? Option values. Rumba simple. Now they ask you to find out the value of this option. That is, how much should I pay for this particular guarantee now? So I have to find out the value of the option or not. So now I should try to find the value of a call having what? These 5 input factors. That's the subject matter of discussion. Everybody yes or no? Okay, now don't ask me any doubt. Let me do the 5 input factors. Also explain you that much more elaborately. Can I proceed or not? Now look at this. See. Facts here. Spot price. First of all, tell me, Abhaya want to borrow money, deposit money. It wants to borrow today, after 1 year. It wants to borrow after 1 year. For how many years? That means it wants to have 1/2. It wants to borrow after what? 1 year. For what? 1 year. His loan period is 1/2. This clarity, are you having that? Next. Spot price. Had I borrowed today, had I borrowed what? Today. Tell me, how much would I pay as interest? 5%. Is the spot rate. What I'm saying, how much percentage? 5%. So we cannot write 5% because I have to pay money in rupees or not. So this should be applied on my notional principal. How much lakhs here? 1 million. Means how much lakhs here? 10 lakhs. So the spot interest is going to be how much here? 10 lakhs into 5% is you want 50,000 is the spot rate. Ennappa yes or no? No. I just convert the interest percentage into what? Rupees. Using what principle? Notional principle. Sollupa yes or no? No. Next is now. If I want to borrow today, I can borrow how much percent? 5%. I'm going to borrow today after 1 year. After 1 year. I'm afraid, not afraid, afraid. I'm afraid about increasing interest rate, decreasing interest rate, increasing interest rate. To protect against a bull, I should go for a call option or put option or call option. I go for a call option. Yes or no? How many year call? 1 year call. Because I am going to exercise after what? 1 year. I'm going to go for what year? 1 year call. I'm going to go for a 1 year call on a reference rate. I'm going to go for 1 year call on what? Suppose let us assume it to be MIBOR. What assumption here? They have not given reference rate and all. It was a small sum only. But assume reference rate to be what? MIBOR. I go for what MIBOR? 1 year MIBOR. How 1 year MIBOR? 2 minus. Not understanding. Now, listen. If I borrow today, any risk? But I am going to borrow after what? 1 year. I am having a risk or not? No. So I go for what option? Call option. Call means right to sell or right to buy. Right to buy after what? 1 year. Right to buy after 1 year. I am having a right to buy after 1 year. What? Yeah, dollar, yeah, share, yeah, interest rate, interest rate. Let's give the interest rate name called as MIBOR. Name called as what? MIBOR. I am going to now have a right to buy MIBOR. I am going to have a right to buy MIBOR. At what price? Strike price. What is strike price here? 4%. What is strike price here? 4%. That means now can I say, I have a right to buy a MIBOR at what strike price? 4%. So strike price is 10 lakhs into 4 gives you what? 40,000. Sollupa, yes or no? No. Okay, now tell me, first of all, if I borrow today, the current MIBOR is how much percent? 5%. So the spot interest is how much? 50,000. But I'm going to borrow today after 1 year, after 1 year. So I go for a strike price of how much percent? 4%. What is strike price? 40,000. Sollupa, so no? No. Rumba simple, all are applied on the notion principle, make it into rupees for me calculation. No. Sollupa, what is risk-free rate of the government security? 3% or 0.02, 0.03. Next is what? Standard deviation. Now, the MIBOR is having a up and down or not? Is the MIBOR same always? No. It may sometimes jump to 8%, jump to 2 and so on. Now tell me, what is the variability of standard deviation of MIBOR? 10% or 0.10. Tell me, what is the term of the option? What how many years here? 1 year. Up to this, everybody having the clarity. So now I have all the 5 inputs. All the 5 inputs here? Spot price, strike price, risk-free rate, standard deviation, term of the option. Everybody, yes or no? Okay, see. There can be lot of misunderstanding in this data. For this, I'm going to give you some other data to check you the numbers. Can I proceed up first? What option? Call option. Only change is, I am not going to borrow after 1 year for 1 year. I am going to borrow after 3 months for 6 months. So tell me, what is the call here? 3/9 call. Other details same here. Notion principle is how much given? So what is the notion principle here? 10 lakhs. Okay. What is the spot rate? 5%. What is the strike price? 4%. This is same. Now, you should tell me the basic input for what? Black-Scholes model. Okay. Now, I am going to borrow after what? 3 months. How many months here? 9 months. Okay. Now, tell me, I go for call option. How many months here? 6 months. I go for a call option, put option, call option. Okay. With what strike price? 4%. What spot price here? 5%. Okay. Now, I go for a call option on what MIBOR? 6 months MIBOR. Call is on what MIBOR here? 6 months MIBOR. I just give a reference call as what? 6 months MIBOR. Okay. Now, spot. Spot is how much? 10 lakhs into how much percent? 5% into in a 6 months MIBOR is always what? Into 6/12. Never go. So tell me what is spot rate? 25,000, right or not? Next is strike price. What is strike price? 10 lakhs. Into how much percent? And what MIBOR? 6 months MIBOR. Into what? 6/12. That gives how much? How much base here? Spot price is 25. What strike price here? 20. Now, rumba simple here. Risk-free rate, no problem. What is risk-free rate here? 3%. What standard deviation? Asking all the facts what same. Tell me, what is the term of the option? Mokka. I want to exercise after what? 3 months. What is the term of the option here? 3 months. I want to exercise after how many months here? 3 months. In the 6 months, the name of the MIBA. Name of what? MIBA. They calculate interest always on what? 6 by 12. Should I repeat? I'll repeat. Okay. See. I am going to borrow today after 3 months. After 3 months. Okay. Now, for how many months here? 6 months. It is a transaction. I can either go for 3 by 9 FRA. If I go for 3 by 9 FRA, I buy MIBA. I buy MIBA or not? No. I buy what MIBA? 6 months MIBA. I buy what? 6 months MIBA. After what? 3 months. And what agreed price? 4%. That is, after 3 months, if the MIBA becomes what? 5%. I receive 5 and pay what? 4 and get 1% gain. I'm going to exercise after what? 3 months. Instead of buying MIBAR, I buy a MIBAR call. I buy what? MIBAR call. What strike price? 4%. That means, now tell me the transaction. When I have a 6 months MIBAR call, listen to my transaction. Good morning, friends. Listen, I have a 6 months MIBAR call. I hold what? 6 months MIBAR call. With a strike price, how much percent? 4%. The term of the option, how many months here? 3 months. This is detail here. Okay. I have what here? I have a 6 months MIBAR call. I hold a 6 months MIBAR call. With what strike price? 4%. What is the term of the option? 3 months. Tell me what is the meaning of this? After 3 months. What? After 3 months. I have a right to. I have what? Right to. What? Buy. Buy what? A 6 months MIBAR. At what percent? 4%. When will I exercise? If the MIBAR after 3 months becomes 10%, what I'll do? I'll exercise and purchase what? 10 MIBAR. Get what? 10% MIBAR. By paying how much percent? 4%. Book a 6% margin, which will be applied on what principle? Notion principle of 10 lakh into what? 6 by 12 because 6 months MIBAR. Everybody have the clarity. Yes or no? No. So did they understand what I'm discussing? No. I'll just put you one more question. Just answer me the everything same. Everything is what? Same. Okay. It is a call option. What call? Call option. Okay. Now, I want to borrow after 5 months. For 3 months. How many months here? 3 months. So tell me what the transaction? What transaction? 5 by 8. The notion principal, how much lakhs? 10 lakhs. What the spot rate? What strike price? Strike price what? 4%. Now tell me, I should go for a call option now. Call option on how many months MIBAR? 3 months MIBAR. I go for what? 3 months MIBAR call option. Go for 3 months MIBAR call option. Can you all explain me the data? What are the data? When I go, I just I just hold a 3 months MIBAR call option. Expiring after what? 5 months. With how much strike price? 5%. Where the gain or loss is booked on what notion principle? 10 lakhs. Is the issue? Are you having clarity or not? Now, tell me what right I am having. So, I am having a right to what? I have a right to buy. Right to buy shares, currencies, MIBAR. Right to buy 90 days MIBAR, 14 days MIBAR, 6 months MIBAR, 90 days. Or what? 3 months MIBAR. Right to buy 3 months MIBAR today, after 5 months, after 5 months. At what strike price? 4%. At the end of 5 months, I see whether MIBAR is more than 4% or less, and then excise rate. Yes or no? In that case, tell me what the spot price? What is spot price? 10 lakhs into how much percent? 5% into what? 3 by 12. Why 3 by 12? 3 months MIBAR. Yes or no? No. What is the strike price? 10 lakhs into 4% into 3 by 12. What is the term of the option? 5 months. Then I'm going to exchange option after how many months here? 5 months. Are you following? And what is standard deviation? How much percentage here? 10%. And what is the risk-free rate? 3%. For this, when I apply Black-Scholes, we are getting what? Premium for this. This option different, this option different, and this option what you are doing in the classroom also is what? Different. Because this is a 3 by 9 call option. This is what? 5 by 8 call option. What you are doing is 1 year into 2 years call. And say 12 by 24 or what? 1 year into 2 years. Since interest rate is always per month, say per annum, so this 3, I'll just say that's what? 0.25, 0.75, etc. in doing the Black-Scholes calculation. I want to answer. Can we proceed or not? Can I proceed with call valuation? No. I'll just give you the notes for these 2 changes after the Black-Scholes is what? Completed. Now, all of you tell me, please, one small help here. Now, Black-Scholes are 5 data required or not? Look at this question here. Abhaya wants to borrow a deposit. When she wants to say company, okay. When Abhay Limited wants to borrow after 1 year. For how many years? 1 year. Now tell me, she goes for a call option, put option. Why? Wants to protect against what? Rising interest rate. Goes for what? Call option. Okay. Now, spot price. If the borrowing is made today, can made how much percent? 5%. For how many years? 1 year, the date of loan. Is what I'm saying. So, what the spot interest rate? 50,000. But I have a right to borrow at 5% or 4% or 4%. So, 4%, how much lakhs notional principal? 10 lakhs. And what does spot say? The strike price here? 40,000. I get this right to borrow today after 1 year, 1 year. The term of the option is how many years here? 1 year. And today what the risk-free rate of interest in the Government of India bond? 3%. What standard deviation of the MIBOR going up and down? 10%. These are facts of the Black-Scholes model. Everybody, yes or no? Copy this. Then we can just do the Black-Scholes model together. Please copy this quickly. So next session, Jason sir, na? Ask Jason to leave sharp. You should not encroach on my next class timing. Will start at exactly what? 1:30. Very, very important discussions are going to be made. Okay. And then so many will be coming. Okay, will be coming on time. Okay, so we'll start at 1:30, go up to 3:30. Okay. Very important discussion to be made. Be here by what? Yesterday I said, na. Yesterday I asked you to be here by 6:30. Very few came. Then I did one secret problem regarding what? Day count convention. I don't have like that for the next session. Please, I have to continue from where I left. Will I be here on time or not? Lunch, come here and eat. Go to Nilgiris, buy water, chips packet, biscuit packet, cool drinks. Okay, nothing okay now. Come here, sit and water, listen. Okay. Finish copying up. Now, shh, all of you. Those are not copy, raise your hands. Okay. Now, Black-Scholes steps, call option valuation. I forgot. Tell me the steps here. Tell me steps. First step, all of you. What first step? ln of S by N. Second step. Second step is what? D1. Third step, D2. Step 4, NTD1, NTD2, ND1, ND2, e power minus TR of value of call. We need not do the remaining 3 because put value is not what? Asked. We want the value put also nothing greater E n minus D1, n minus D2 and value of put. Now, see. Tell me, what is D1 formula? What is D1 formula? D1 is equal to what? ln of S by X plus sigma square by 2 plus RF into T whole divided by sigma into square root of T. Yes or not? What is D2? D1 minus sigma into square root of D. NTD1 normal table value of D1. NTD2 normal table value of D2. ND1 is what? 0.5 plus or minus NTD1. ND2 is 0.5 plus or minus NTD2. Next is what is e power minus here is what? Discount factor. Tell me call value. Value of call is equal to what? S into ND1 minus X into e power minus TRF into ND2. This is a call value. I want an answer. Yes or no? Okay. Shall I start doing it together? No. Okay. You tell the numbers from the workbook. You have the tables. If a small change happens here, I might have used some other table to calculate. Table mean differences may change. Okay, right now, next. Valuation of interest rate option. Valuation of interest rate option. Bracket la call option. Valuation of interest rate option. In bracket write what? Call option. Using. Valuation of interest rate option using Black-Scholes model. Valuation of interest rate option using Black-Scholes model. Using Black-Scholes model. Okay, one by one. Point number one. What is point number one? ln of s by x. ln of s by x. ln of 50,000 divided by 40,000. Spot price is 50, strike price is what? 40. Please tell me, are you following up? ln of 50,000 by 40,000. Can you tell me what is 50,000 by 40,000? 1.25. Look at your workbook and tell me what is ln of 1.25. I think you'll be having only 1.2, 1.3, etc. Kadaba? Round off and tell me what is 1.25, the number in the workbook. Solupa. 0.22. It is 0.22314. ln of 1.25 is 0.22. 1.25 straight away available. 0.22314. ln of 1.25 is 0.22314. Respond yes or no. Next. D1 is equal to, point number 2, D1 is equal to, write the formula first. D1 is equal to ln of s by x plus. Shall I write and show to you? Risk. Okay. ln of s by x, all of you, plus. So plus what? Sigma squared by 2 plus rf, put a bracket, into what? T. Whole divided by sigma into square root of t. Whole divided by sigma into square root of t. ln of s by x plus sigma squared by 2 plus rf into t, whole divided by sigma into square root of t. Please substitute the formula copy. Now mind la irukonu. Can I say? Now please. Sometimes I feel insulted. It's not correct. I'm seriously discussing. There's not a right to behave. Shall I proceed? Okay. Now, substitute the numbers. What is ln of s by x? So look. 0.22314 plus sigma squared is 0.1 square divided by 2. 0.1 square divided by 2 plus rf is what? 0.03. Into t is 1 year. T is what? 1 year. Into 1 you need not write. Yes or no? Solupa. Whole divided by sigma into 0.1 into square root of 1 is what? 1. Hence I did not write. So tell me it is 0.22314 is what? ln of x by x. 0.1 square is what? Sigma square by 2 plus what is 0.03 r into t is 1. Hence I did not write it. Kadaba. Whole divided by sigma into 0.1 into square root of 1 is what? 1. Tell me the number please. 2.5814. Number kadaba 2.5814. D2 is equal to, D2 is equal to D1 minus sigma into square root of t. D1 minus sigma into square root of t, which is equal to 2.5814 minus 0.1. 2.5814 minus 0.1. 2.5814 minus 0.1. Number please. 2.4814. 2.4814. NTD1. Normal table value. We have only 2 decimals in our workbook. So normal table value of 2.58. NTD1. Normal table value of 2.58. Can somebody look at the normal table and tell me what is 2.58 value please? 0.49? Okay, I wrote as 0.49506. I have it. 0.49. Some other table. 5.1 506. Accepted. 0.49506. NTD1. Normal table value of 2.48. Sorry, NTD2. Normal table value of 2.48. Look at the normal table and tell me what is 2.48 value please. 0.49? Had as 0.49343. It has taken from some other table having 5 decimals. Okay, not an issue. 0.49343. Now, next is what? ND1. Next is ND1 is equal to 0.5 plus NTD1. 0.5 plus NTD1 is equal to 0.5 plus 0.49506. 0.5 plus 0.49506. Total place, what total? 0.99506. ND2. 0.5 plus NTD2. 0.5 plus NTD2. 0.5 plus 0.49343. 0.5 plus 0.49343. Number of place 0.99343. 0.99343. E power minus TRF. And the minus on the red line, it is hidden. Okay, so e power minus TRF. It happened like e power minus TRF. Solupa. Now, what is RF? 3%. What is T? 1 year. E power minus 1 into 0.03. E power minus 1 into 0.03 is equal to e power minus 0.03. E power minus 0.03. Number already by hearted. What is e power 0.03? 1.03045. Number kapa. So 1 divided by 1.03045. What number please? 0.9705, yeah, or 0.97045. E power minus TRF is 0.97045. Having the numbers in 5 decimals. 0.97045. Respond, yeah. Next, I have to find out what? Value of the call. Formula please. What is the value of the call? Right on. Next, VC. Step number 9. Yes. VC is equal to S into ND1. S into ND1 minus X into e power minus TRF into ND2. S into ND1 minus X into e power minus TRF into ND2. Now, spot price is 50,000, interest or not? 50,000 into 0.99506. 50,000 into 0.99506 minus strike price is 40,000 now. 40,000 into 0.97045. 40,000 into 0.97045 into 0.99343. Into 0.99343. Can you all tell me what is the number please? 11,190. 11,190. I should pay a premium to the writer. How much rupees? 11,190 rupees should be the premium paid for this interest rate cap on a notional principal of 10 lakhs. I can even enter into a cap with a notional principal of 1 lakh or 5 lakhs and so on. So based on the notional principal only, interest is quantified and also the premium. So this is a premium on the interest rate call. Innappa, yes or no? Now write down. Abhaya Limited should pay. Abhaya Limited should pay rupees 11,190 as premium. Abhaya Limited should pay rupees 11,190 as premium. Should pay rupees 11,190 as premium to the writer. To the writer. To purchase. To the writer to purchase 1/2. 1/2 means what? Call exercising after 1 year. Interest to be calculated for what? 1 year. To purchase 1/2 call option. To purchase 1/2 call option with a strike price of. To purchase 1/2 call option with a strike price of how much? Strike price of 4%. The strike price of 4%. The strike price of 4%. On a notional principal. The strike price of 4%. On a notional principal of how much lakhs? 10 lakhs. On a notional principal of 10 lakhs. On a notional principal of 10 lakhs. They did not tell me the reference rate. If they told me to include what? The LIBOR call or a LIBOR call, etc. Since they did not tell, I just want to ignore it. So this is how we should value what? Call ups. Put na nothing rate here. Same thing, only 2 more steps extra. What are 2 more steps here? N minus D1, N minus D2. Then what is N minus D1? 1 minus ND1, 1 minus ND2. Then what is the value of the port? X into e power minus TRF into N minus D2 minus S into N minus D1. Everybody have the clarity or not? Now, see, understand. In our, say, this session, that is throughout this batch, We have discussed all markets, main markets are what? Discussed. We discuss about currency market. We discuss about what? The securities market. We discuss about the bond market. Also called as what? Interest rate market. In all markets, along with their respective derivatives as we what? Discuss, including their valuations. This is your syllabus. Apart from that, we discuss what the discounted concept what portfolio and other issues. But mainly, this is what I studied as what syllabus in our say session. I'll have the clarity. No, with this we completed the interest rate cap valuation. Can I proceed or not? No, no. 15 minutes yearly. How I can leave here? Is atrocious. Okay. Don't talk. I'll have an introduction and leave you. Shh. Shh. Stop talking. Don't touch. Romba easy and very small. This is the RTP question. Take question number 13 in our swap chapter. Take don't touch. Question 13 is, I will leave you spot on time 9:30. Please don't touch. Romba simple discussion here. 1 minute discussion over. I bring an example. Okay, now see. Now, is an RTP question. 2 parts are there. I'll discuss part A. Part B will discuss in the next session. Please. Shh. Suppose 1 year cap. Cap means what option? Super. 1 year cap has a cap rate of 8%. What is 8%? Strike price. Fixed rate leg down vehicle has what price? Strike price. And the notional amount of 100 crores. Frequency of settlement is quarterly. And the reference rate is 3 months MIBAR. Assume the 3 months MIBAR for the next 4 quarters happens to be 8.7, 8, 7.8, and then what? 8.2%. You are required to compute the payoff for each quarter. Payoff for what? Each quarter. Now, listen. What I am now discussing is called as swap options. What options here? That is, I am having an option on a swap. I am having an option on what? A swap. This is called as what option? Swap option, payoff. They ask you to want to calculate. Everybody listening or not? Now, see, rumba simple here. Now, I'll tell you swap and say a small change happens for what? Swap option. Okay, now, see. There are 2 persons here. For example, A, any name given? Okay, I'll give the name for them. A and then what? B. Or 2 persons, A and B. Okay, now, suppose let's assume we are A. Okay, the other party is what? B. We want to have a cap. Cap means what? Purchase. Right to buy. Cap means what? Right to buy. I have a right to buy what? MIBAR. Buying means paying or receiving or receiving. I have a right to receive. I have a right to what? Receive. Receive what? MIBAR. And the MIBAR, a lot of names are there. Overnight MIBAR, 3 days MIBAR, 14 days MIBAR, 3 months MIBAR, 3 months MIBAR. I have a right to receive what? 3 months MIBAR and pay what fixed interest? 8%. And pay how much percent here? 8%. So the MIBAR name is what MIBAR? 3 months MIBAR. Always I'm by 3 by 12 to calculate what? The net amount. Yes or no? No. Rumba simple here. This is for how much period? How many years here? 1 year. Okay. So for how many years here? 1 year. And what the recent date? Once in how many months here? 3 months. Okay. Now, simple up. If this is an interest rate swap, it's going to be what swap here? Interest rate swap. What is the assumption is, what is the transaction is, once in every 3 months, I'll exchange MIBAR against 8% or not? No. So, for example, first floating rate is 8.7. So, I receive what? 8.7 and pay what? 8%. First swap cash flow is 0.7% gain for me. Listening, huh? Next. And this is assumed to be the fixing rate. Assumed to be what idea? Fixing rate is going to be exchange. Okay, so question is not clear. Now, next is say settlement date. I pay how much? I receive what? 8%. And pay how much percent? 8%. What is swap cash flow? 0. In third leg, I receive how much percent? 7.8. And pay what? 8%. How much is upper loss? 0.2%. Fourth case, I receive what? 8.2. And pay what? 8%. How much I get? 0.2% gain. This is my swap cash flow. Instead of swap, I have swap option. I want a swap option. That is called as what? A cap. Rumba simple. Whenever I have a gain, I receive. Whenever I have a loss, I lapse it. That's what I'm saying. That is, the swap will give me only what cash flow? Positive cash flow. Will never give me what? Negative. Rumba simple. I ask a question. First swap transaction, after 3 months, so I am going to exchange what? You assume this 8 points will determine today to exchange after what? 3 months. And this is after one, say first month, exchange after what? 6 months and so on. Okay. This is going to be exchange here. Now I have a right to receive what? 8%. And pay what? 8%. I have a right to receive what? 8.7. And pay what? 8%. First swap cash flow will be exercised, lapsed. Exercise or lapsed? Exercise. Okay. Now, second swap cash flow, I have a right to receive what? 8%. Pay what? 8%. Exercise or lapse? Indifferent. Exercise also 0. Lapse also what? 0. Nothing. No. What I'm saying now. Third swap cash flow, I am going to receive what? 7.8. I have the right to receive to Libor worth what? 7.8. And to pay what? 8%. Exercise or lapse? Lapse. I don't pay the party. I am going to want a lapse and have 0 cash flow. So no. No. Fourth case, I am having a right to receive a pay what? Right to receive 8.2 and pay what? Hey, exercise or lapse? Exercise. So I'll be having 2 exercises and then what? 2 lapses. Idamba interest rate cap response. No. In the interest rate cap, I just receive the swap in the swap options. I receive when it is favorable to me, and when it is adverse means what? I allow it to lapse and have what? A 0 cash flow. And A is called as what? Holder of the swap option, and B is called as what? Writer. Writer will never get anything from the swap. He only want pays when the holder what? Exercise. Father can charge premium or not. No need to say how to calculate premium. It's like 3 call options. You know how many call options here? 4 call options are there or not? How many call options here? 4 call options are there. So you just value using what? Black-Scholes model. All the 4 calls and what? Added. So you're going to pay how many premiums here? 4 premium because you're going to have how many call options here? 4 call option is the meaning of this particular transaction. Everybody have the clarity or not? Now, that swap option valuation now beyond our discussion, not what asking the examination, but you know how the cash flow occurs or not? Yes. Is a discussion regarding this particular problem. Everybody, yes or no? Let's complete the answer. Question number. So about question number. Tell me question number. Question number 13. Write down. Problem number 13, part A. We'll complete quickly. Problem number 13, part A. Problem number 13, part A. Problem number 13, part A. Okay. Just draw this diagram. A, B. A called as holder, B called as what? Writer. A, B. A called as holder, B called as what? Writer. A is going to receive what? 3 months MIBAR and pay 8%. Receive 3 months MIBAR and pay 8%. Are you all following? Huh? No. Below that, right? A is holding. A is holding. I will finish copying this diagram. Huh? Yes, A is holding. An interest rate swap. A is holding an interest rate swap call option. A is holding an interest rate swap call option where he gets the right to receive. Where he gets the right to receive. He gets the right to receive what? 3 months MIBAR. Where he gets the right to receive 3 months MIBAR. In exchange for how much percent? 8%. In exchange for 8%. Full stop. The notional principal is The notional principal is how many crores? 100 crores. The notional principal is 100 crores. And the interest is exchanged. And interest is exchanged once in how many months? 3 months. And the interest rate is exchanged once in 3 months. For a period of how many years? 1 year. Interest rate exchange once in 3 months for a period of 1 year. For a period of 1 year. See, in the MIBAR, they have not clarified whether it is a previous reset MIBAR or what? Current. In the exam confusion, that MIBAR should be exchanged against what? That fixed rate. So you need not worry about which is previous or current reset day. Either exchanging rate like that, you have to think, can I proceed or not? No. Shall I proceed? Right on. Next, last step. So we have understood the transaction or not? Right on. Option cash flows to the holder. 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 Okay. Have the following columns. First column is period. First column is period. Second column write as floating rate. What rate here? Floating rate. What's the name of the floating rate? MIBAR. Third column is what rate? Fixed rate. Third column is fixed rate. 3 more columns are there. Just write nearer. One word. Okay. Next is ERL. ERL means what? Exercise or lapse. ERL. Exercise or lapse. One broad column computation. One broad column computation. Last column amount. One broad column computation. Last column is what? Amount. Okay. Now, let's write the period. I exchange when? First swap cash flow happens in what? 3 months. Then happens in what? 6 months. Then happens in what? 9 months. Finally in 12 months. Ennappa? Yes or no? Okay. Floating rate to be exchanged after 3 months given as how much percent? 8.5, yeah? 8.7%. 6 months. These are 3 months MIBAR. What percentage here? 8%. 3 months MIBAR after 9 months. 7.8%. And 12 months? 8.2%. What is fixed rate like? 8%, 8%, 8%, 8%. Now you should tell me, I'm a caller, put holder or call holder. I have the right to buy floating. Right to buy what? Floating. Buy means what? Receive. Now, will I buy a floating what? 8.75, 8% or not? Yes. Exercise or lapse? Exercise. Will I buy a 8% MIBAR what? 8%? Yes. Exercise, yes or no? Indifferent. I call as what? Lapse. Now both is going to give me what? Same answer. Will I buy a MIBAR what? 7.8% for 8%? No. What do you do? I just want lapse it. Will I buy a MIBAR what? 8.2% for 8%? Yes. Exercise and lapse? Exercise. Now, we have to compute now. Tell me. The computation is done on how much lakhs? How many crores here? 100 crores. So it is on, let's write the numbers in crores. Okay, 100 crores into, what is the gain please? How much percent? 0.7% into what? 3 by 12. Why 3 by 12? 3 months MIBAR. Into what? 3 by 12. Clarity irukka? 100 crores into 0.7% into 3 by 12. Somebody tell me the number please. 0.175 crores. This is 0.175 crores. Lapsed now, what the cash flow? 0. I need not pay or what? Receive. Lapsed means cash flow is what? 0. Now, in this case, notional principal is 100 crores. How much makers gain? 0.2% into what? 3 by 12. Tell me what is the swap option cash flow here? 0.05 crores. 0.05 crores. So this is what we call as what option here? Swap option. Everybody, are you have the clarity or not? Just I am having 5 more minutes left here. I'll surely complete part B in 5 minutes. We'll be discussing next time. Please, same type very quickly. Now, Don't shout and all. You came late. Shh. Now, don't waste time. In this, I'll complete it. Now, see, same type of question. Part B. Suppose 1 year floor has a rate of how much percent? 4%. And a notion principal of 200 crores. Frequency how many months? 3 months MIBAR. So, and the MIBAR is given as follows. Can I pass on up? Now, tell me. Floor na, call option na, put option na. We'll write together. Part B. Write down part B. Shh. It's call option na, put option na, put option. Let's draw the diagram to have a clarity. There are 2 persons, namely what? A and then B. The two, namely what? A and then B. So we are what? A. Other party is what? B. I am a holder. Other party is what? Writer. Okay. Now, I have a right to buy, a right to sell. Sell. What is the option here? Put option. I have a right to sell. I have a right to sell what? 3 months MIBAR. Selling means what? Paying. I am going to pay what? 3 months MIBAR. I am going to pay 3 months MIBAR. In exchange for a strike price, how much percent? How much percent? 4%. Right? How much percent? 4%. Okay. Are you all following what I am saying? No. Write down. Next. Holder has right to sell MIBAR. Holder has right to sell 3 months MIBAR. Holder has right to sell 3 months MIBAR in exchange for 4% fixed rate. Holder has right to sell 3 months MIBAR in exchange for 4% fixed rate. The notional principal is how many crores? 200 crores. The notional principal is 200 crores. The interest is exchanged. The interest is exchanged once in how many months? 3 months. The interest is exchanged once in 3 months. The interest is exchanged once in 3 months. For a period of how many years? 1 year. For the period of 1 year. For a period of 1 year. Okay. Have the following columns. Period. First column is period. Same columns here. Second column is what? Floating. Tell me the third column, fixed. Fourth column what? Exercise or labs. Fifth column is computation. Last column is amount. Computation and then amount. Okay. Tell me the exchange dates. What are dates here? 3 months. So next is what? 6 months, 9 months, 12 months. Look at the question. Tell me what were the floating rates to be exchanged on those recent dates. Tell me what it is. 4.7, 4.4, 3.8, 3.4. What is the fixed rate? 4%, 4%, 4%, 4%. Okay, so look. I have a right to sell a MIBAR what? 4.7 for how much percent? 4%. Will exchange or labs? Labs. I have a right to sell a MIBAR what? 4.4 for what? 4%. Exercise or labs? Labs. I have a right to sell a MIBAR worth what? 3.8 for how much percent? 4%. That means pay 3.8, receive what? 4. Exercise and labs? Exercise. I have a right to sell MIBAR worth 3.4 for how much percent? 4. Pay 3.4 to get what? 4. Exercise and labs? Exercise. Tell the computation here. Computation is 200 crores into, first case is labs. I forgot. Second case is what? Labs. Third is what? 200 crores into 0.2% into 3 by 12. Am I right or not? No. Tell me the number, please. 0.10, 0.10 crores. This is 200 crores into 0.6% into what? 3 by 12. What is the number, please? 0.30 crores. 0.30 crores. So with this, we complete that particular sum. We'll continue with this and start with the currency swap in the next session.